Okay.
Thank you very much. Good afternoon. I'm Betty Pendergrass, and I'm calling to order the County Employees Retirement System regular quarterly meeting. Mr. Bronco, could you read the opening statement, please, sir?
Course. This is a regular meeting of the County Employees Retirement System Board of Trustees. This meeting is being broadcast via video teleconference pursuant to KRS 61826 and may be viewed by the public at the Kentucky Public Pension Authority's offices located at 1260 Louisville Road in Frankfort, Kentucky. It is also being broadcast to the public live via Facebook. If you are speaking and are not appearing by video, please identify yourself before talking. If the video or audio broadcast is interrupted, we will attempt to reestablish a connection. If a connection cannot be reestablished within 30 minutes, the meeting will be adjourned and rescheduled to a later date.
Thank you. Ms. Rankin, could you call roll, please?
Yes, ma'am. Ms. Pendergrass,
Here.
Dr. Carver,
Here.
Mr. Cheatham,
Here.
Mr. Foster,
I'm here.
Mr. Fulkerson,
Here.
Dr. Hackbart,
Here.
Dr. Milkman,
Here.
Mr. O'Mara,
Here.
and Mr. Powell.
Here.
Thank you.
Thank you. Could you read our public comment, please?
Yes, ma'am. The public comment today comes from a Mr. Mark Doran, and it reads as follows. The unfunded liabilities basically arose for many reasons, whether it was not paying actuarial rates, planning for COLAs, or investment oversight, the system was not properly managed. The employees, retirees, fulfilled their funding responsibilities. Attempts have now been made to address the unfunded liability, which is necessary. The problem is, inflation is being ignored by both the state legislators and our KPPA representatives, especially the CERS board. It's not realistic to expect retirees to maintain a stagnated 2011 level pension benefit. The CERS board has been decreasing participating entity contributions recently instead of taking any approach to plan for a COLA. From a CERS contributing participant standpoint, I understand pensions are already expensive to fund. I also understand that people are the most important asset and deserve to be treated better than we have been. My former employer hasn't frozen the taxes I pay at 2011 levels. They can fund a retiree COLA instead of a pet project or two. Don't just read this and move on. We need you to speak to this topic and help now. I've been told KPPA and CERS don't feel as though it's their duty to actively promote any increase. It most definitely is. You are there to responsibly and fully represent your members. We have sacrificed in its time we receive some inflation relief. Please don't move on to the next order of business until you speak about this. Mark Doran. Thank you.
Thank you. I'm going to break tradition and respond to Mr. Doran. He has some very valid questions. We have not ignored the numerous requests for adjustments to CERS benefits to reflect the impact of inflation on our retirees. I understand the difficulties facing our retirees, and I believe that they deserve a thoughtful answer. Yes, the statute governing COLAs does state very clearly that COLAs will not be granted until the system is funded at more than 100%. But instead of just pointing to that statute, I want to outline some of the key factors that affect this discussion. And the discussion has been ongoing. You deserve to hear the facts about benefit adjustments for CERS retirees. First, in the 1950s, when the CERS system was created, it was not designed to include inflation adjustments to the defined benefit provisions. We cannot revise that structure now. Ideally, inflation adjustments would have been funded with employer and employee contributions. The COLAs paid in the early 20s were spending down a perceived surplus and caused much of the shortfall in our current funded status, especially when the COLAs continued after the funded status decreased below 100%. Second, there is no way to increase benefits without increasing employer contributions. Yes, we have investment income, but those resources are dedicated to funding the basic defined benefit provisions, and we don't want to undermine those benefits. If we used investment dollars, the employer contributions would increase to fill that gap. At this point, we cannot change the employee contributions paid from 1950 to 2023, which only leaves the employer to fund any benefit adjustments. Third, federal law restricts many of our options for funding benefit adjustments. It would be nice to explore creative options, but some of those post-retirement options are not allowable under federal law. These restrictions are based on the tax-exempt provisions for the contributions to CERS. This board is laser focused on increasing the CERS funded status and ensuring that employer contribution rates are stable. Employer contribution rates affect active members' pay rates and jobs, as well as funding public services for our communities. As trustees, we believe that our fiduciary duty requires us to actively protect the CERS basic benefits and improve the system's funded status. We hear your concerns and we understand the difficulty of managing a fixed income with inflationary pressures. We will continue to explore options and discuss possibilities. The next item on our agenda is approval of minutes. We have three meetings that need approval: December 4th, January 17th, and February 6th. January 17th and February 6th were educational sessions and don't have a lot of detail in those particular minutes. I'd like to approve these as a group, if that's okay with the trustees. Do I have a motion to approve minutes?
So moved. Second.
Thank you very much. We had a motion from Mr. Fulkerson and a second from Mr. O'Mara. Do we have any edits, corrections, adjustments in the minutes? Hearing none, all those in favor of approving the minutes for those three meetings, please say aye.
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 Any opposed? All right, hearing none, the minutes for the meetings of December 4th, January 17th, and February 6th are all approved. Next item on our agenda is the Personnel Committee. Mr. Fulkerson, will you outline the two recommendations that the Personnel Committee has sent to the board for approval, please, sir?
Yes, thank you. The first is the CEO performance plan. CRS Finance Committee reviewed and discussed the CRS performance plan for 2024. Mr. Cheatham made some recommendations on additional topics for Mr. Owens to include as trustee educational topics. The plan was passed unanimously with these changes. And B was the strategic plan objectives. The CRS Personnel Committee unanimously approved the CRS strategic plan objectives for adoption in the CRS strategic plan. The HR director noted that the Personnel Policy Manual would need to be updated at a future date to conclude with the Personnel Committee's strategic plan.
My goodness.
Did you want to make a motion for each one of those?
I think we can take them together.
Okay. We have a motion to approve the CEO performance plan and the Personnel Committee strategic plan objectives. Do I hear a second?
Second.
Thank you, Dr. Milkman. Any questions for Mr. Fulkerson on either one of these items? All those in favor of the motion to approve these two recommendations from the Personnel Committee, please say aye.
Aye.
Aye. Any opposed? That motion carries, and those items are approved. The next item on our agenda is the Finance Committee report. I'll hand the mic over to Mr. O'Mara.
Thank you very much. I would like to, we have several things in the Finance Committee, but what I would like to do first is to introduce Mr. Adam Gordon from the Auditor of Public Accounts. who would like to present the proportional share audits. So, Mr. Gordon, would you want to give us a summary, please?
Yes, thank you, Mr. O'Mara. So good afternoon. Again, my name is Adam Gordon. I'm from the Auditor of Public Accounts Office, and I'm the auditor in charge of the Kentucky Public Pensions Authority Proportionate Share Audit for fiscal year 23. Linda Hinton is the audit manager, and Matt Fry is the executive director. As you know, KRS requires that at least once every 5 years the APA is to perform KPPA's audit. We have audited the financial statements in 2023, so now we're on the tail end doing the proportionate share audit. The last time we did the proportionate share audit was back in fiscal year 18. Since then, it's been 5 years. Management is still responsible for the preparation and fair presentation of these schedules. The proportionate share schedules report on the cost-sharing retirement plans of employers' share of liabilities, deferred outflows and inflows, and related expenses for both pension and OPEB. We have audited the schedules prepared by KPPA's actuaries and will provide management with 2 reports. So I believe they start on page 20, and this one is for pension. So we have 2 audit letters for those, so that both are clean opinions. And then starting on page 32 is the OPEB opinions, and there's also 2 for those, and those are both clean. Our end of field work for the audit is planned for the KPPA board meeting, which I believe will be March 21st. Once that's approved, we will send the signed letters and issue these reports. The schedules themselves are available if you all need to look at those. Just in these minutes right now, it's just the letters. So.
Those schedules that he's referring to can be found in the KPPA Audit Committee report. There's 400 or 500 pages of those, but if you really want to dig into them, you can find them in that board book.
Yes, and also just to note, when we do issue them, we'll also have an Excel file that will provide management, and it'll be a lot easier to read and to filter as well. So, as part of our audit, we are also required to communicate to those charged with governance certain topics. We will be emailing the letter to the chair of the KPPA Audit Committee and chair of the full board, who is then responsible to distribute to all the board members. We noted no significant unusual transactions, uncorrected misstatements, significant policy changes, or significant deficiencies or disagreements with management, and we did not note any unusual items in the letter. As I mentioned before, our opinion is clean for both schedules. There were no findings or issues that came to our attention, and we anticipate issuing an unmodified or clean opinion. Lastly, I would like to thank all of KPPA's management and staff, the actuaries, everyone that helped with the financial statement audit and this audit. It greatly helped make this audit more efficient. And if you all need anything from me, just let me know. But that concludes my presentation. So thank you all.
Thank you, Adam. I believe this says it's looking for an acceptance, but I'm not sure the
Mike Lamb had his hand up for a question.
Oh,
It
sorry,
was on
thank you.
it was on accident. Sorry. I do not have it.
Okay.
Well, we'll wait back later, Mike. So we have on the agenda acceptance, but this is more informational. The final report will be sent to the KPPA full board. I'll defer to the will of the board if they want to have a motion to accept. Hearing none, I think any other questions for Mr. Gordon? All right, thank you very much. We appreciate it.
Yeah, thank you.
Yeah. And thank you, Mr. Gordon. The board appreciates the work that you do for us.
Next, let's have Mr. Lamb report quarterly financial update.
Sherry, we're going to start on page 46, I believe. Thank you. Near the bottom of that page, the total fiduciary net position for the 2C plans at the end of the second quarter is $12.4 billion. That's up 13.17% from the second quarter of fiscal year 2023, which was $10.9 billion. This year is $1.4 billion higher. It's driven by the overall increase in the investments at fair value, which are 13.68%, or also $1.4 billion higher. This is predominantly in the public equities investment asset class, which is up 18.59%. If we go to the statement of changes on page 47, the increase in fiduciary net position for the 6 months ended is $580 million on the third column down there near the bottom. And that is, in comparison to the prior year, is $406 million higher. The prior year amount was 173.9. If we move further down to the contribution report for pension funds on page 48, the net contribution line, the one that's in yellow there, shows the C non-hazardous plan, and the C hazardous plan reported a positive net contribution of $50 million and $53.5 million respectively. The non-hazardous plan had a total inflows from all areas totaling $536.8 million. That's $57.9 million increase over the prior year amount of $478.9 million. This is most notably in employer contributions, which are $30.3 million, or 10.08% more than the prior year's same period. The increase in employer contributions is driven by an approximate 10% increase in employer salaries, as well as an increase in actual members. The employer rates are fairly consistent year to year, 23.34% in the current year versus 23.4% in the prior year. The C non-hazardous members are up 4,210 members, or 5%. Mr. O'Mara had a question in the finance meeting about the increase in employees or members versus salaries. And so I looked into that and saw that there was definitely a 5% increase in members as well as an increase in salaries. Member contributions are also up 10.35%, or $7.1 million, due to the increase in employee salaries as well as headcount increase in membership. The hazards plan has total inflows from all areas of $223.6 million, which is an increase of $23.9 million over the prior year, with the largest increase being in the line item employer contributions. It's $12.2 million higher. That increase is also due to the increase in employee salaries and in headcount. The C hazardous members are up 2,071, or 25.5% versus the prior year. The outflows for both the plans were higher than the prior year, related to more benefits, payments, and refunds. $19.8 million and $8.1 million higher, respectively. The unrealized gains for both the non-HAS plan and the HAS plan were positive at $316.9 million and $112.4 million. If we remove the net investment income of $102.4 million from the 2024 item and the $36.6 million for both plans, we see the bottom chart. We see in the bottom chart that the net contribution, or the cash flow, is negative $52.4 million for the non-hazardous plan and positive $16.9 million for the hazardous plan. Before I move to the insurance statements, any questions on the pension statements? Okay, near the bottom of page 49.
Wait a minute. So when we added these employees, are we better off or worse off according to this statement?
Well, the more employees that you have, and you will have more member contributions based on their salaries. You also have more employer contribution based on the contributions the employers must pay. I think the more employees that the C plans have, the healthier the system will be in the long run. Yeah, so I think you're better off with more employees this year versus last year.
These new employees are all joining in under the Tier 3 benefit, which is the hybrid cash plan and has a lower cost to the system for benefits.
Thank you.
You're welcome. Thank you, Betty. I think I was on page 49, the insurance statements. If you'll see at the bottom, the net position for the two plans is 5.1 billion, which is up 11.87% from the prior year's second quarter. That's $540 million higher, and is driven by the overall increase in investments at fair value, which are 11.55% higher. Again, that's predominantly in the public equities investment asset class, which is up 17.07%. We move on to the statement of changes on page 50. The increase in fiduciary net position for the 6 months ended is 195 million, in comparison to the prior year amount of 72 million. That's $123 million higher. And then if we spend some time on the contribution reports on page 51, it shows that the C non-hazardous plan had a positive net contribution of 8.4 million, while the C hazardous plan shows a negative $14.6 million for Q2. If we take out the net investment income of 38.8 million and 18 million, you can see in the bottom chart that the cash flow for the non-hazardous plan is minus 30.4 million, and the non-hazardous is minus 32.6 million. The non-haz insurance has $45.1 million less in employer contributions, offset by a slight increase in the Humana gain share of 4.5 million. And their hazardous plan has 12.6 million less in employer contributions, offset by an increase of 723,000 in the gain share. So those contribution rates are lower because the funds are nearly 100% funded, if not over, reducing the employer contributions required. And that's all I
Mr.
have.
Powell had a question.
Well, I actually had a comment, but he addressed it. Yes, the C plans insurance are overfunded, which is why the contributions are in negative numbers, trying to get back to the magical 100% funding level. And so that's nothing. I just wanted to make everyone aware that it was nothing. It's not an issue that at the trust is losing money. It's just that it's overly funded, and so as a result, the contribution rates or the contribution levels are in negative numbers until we reach that magical 100%.
Correct. Thank you, Mr. Powell. I think the next statement is outstanding invoices by employer for the C plans. The 1233 amount of $3.2 million is 2% higher than the 9/30/2023 amount of $3.1 million. This year lists the top 10 employers with open invoices. All 5 have asterisks by their name. The top 5 have asterisks by their name, showing that their invoices have been turned over to legal for further action. The Kentucky River Regional Jail is all admitted employer invoices. The city of Covington is related to pension spiking and reinstatement. Kenton County Airport is related to pension spiking. The city of Fort Thomas, pension spiking, and Livingston Fiscal Court is monthly reporting and health insurance reimbursements. The next page shows me the penalty invoices that were waived for the last quarter. There was 12 of them, totaling $24,000. We had 20 penalty invoices created for a total of $20,000, and 40 penalty invoices were paid for a total of $48,000. The next statement is the admin budget.
Dr. Hagbart has his hand raised.
Sure.
You're muted.
Mr. Hagbart, you're on mute. Sorry.
Sorry about that. Could you explain a little bit about the penalties and the waivers of penalties?
Yeah, so a lot of times the employers are required to report and submit payment, I think by the 10th of every month. On occasion, they're late in doing so. We have some guidance in our policies as to when we can waive that, and we put comments out there for why we did that. For example, they might have a new reporting official that's getting used to how to report. There was one instance in this case where we had an issue with it was our own fault as to why that report didn't get put in on time. So the system creates that penalty invoice, and then we can go in there and waive it. And so that's the reasons for those happening. The minimum penalty for not reporting on time is $1,000, and that's set by statute. A lot of these that are at $1,000 because they're smaller entities. The penalty for filing late is based on the amount that you owe, and most of them owe smaller amounts. When you get into some of the larger agencies, the penalty would be higher based on the statutory interest rate that's applied to that penalty.
So the penalty is statutory then, that we have to.
Correct. And then we have some internal guidance that we use and to waive them again based on reasons that we note there. And we work with the employers to, if they've got a new official or if they're having system issues, we work with them quite often and actually waive penalties for a couple months, giving them an opportunity to get their systems on track.
All right, go ahead, Mike.
I think it's page 56. Yes, so this is the admin budget. This is the new summary tab that I put in. I went through the detail of the admin budget at the Finance Committee meeting. I'm welcome to I would entertain any questions you have on the detail if needed, and they're presented in the pages behind here. But the summary that's put there just kind of shows you that under the personnel staff subtotal, we've spent nearly $17 million, or 49% of the budget. Within this category, we see that all the line items have more than 50% remaining, except for workers' comp. That was a one-time annual fee that's already been paid for the year, so it should be on budget when we get to the end of the year. For legal, in total, we're right on budget, but there are some specific line items that are approaching their annual capacity. We are watching these closely and will adjust within the legal categories as needed. For auditing, we were billed by the APA for the ACFR. We still have $85,000 left in the budget. We anticipate a $35,000 invoice for the proportionate share audits that were just discussed prior to my presentation. And then all other personnel categories and line items have more than 50% capacity left, bringing the total category to $20.1 million for the 6 months, with 51.86% left to spend. That's 6.96% higher in dollar amounts than the prior year. In the operational subtotal, it's at $2.3 million with 66.12% of the budget left to spend, and that is $243,000 or 11.93% higher than the prior year's comparative total. The computer software equipment is 25.36% higher, but we're still well under budget, and our postage is 60.15% higher, but also well under budget. So total budget prior to reserve is at $24.6 million with 58.96% left to spend, and is 7.47% higher than the prior year, or $1.4 million. If there's no further questions, that is the end of my presentation.
Thank you very much. Next, we'll go to page 60, hazardous duty requests that were presented to the committee and recommended to bring before the board. Mr. Surratt, would you like to present this for us, please?
Yes, I will. Good afternoon. Today, all we have is 9 positions being requested for hazardous duty coverage. All of the positions are police, fire, and EMT position requests. KPPA has reviewed all the information and they do meet statutory guidelines for hazardous duty. All the position questionnaires and job descriptions were included as well. CERS Finance Committee did approve these positions, and therefore we are requesting the Board of Trustees also approve these positions for hazardous duty.
And so we make, the committee makes a motion to approve as presented.
Do we have a second to that motion?
Second.
Any questions about these positions? All those in favor of approving these positions for hazardous duty, please say aye.
Aye.
Any opposed? The motion is approved. Back to you, Bill.
All right, thank you, Mr. Surratt. Next is the investment trust budget, which is page 61. And I'll ask Mr. Willer to present on that, please.
Sure. Apologies. Very quickly, thank you, Sherry. Good page. Through the first 6 months of the fiscal year, actual expenses are running well below the amounts budgeted for the year, with approximately 75% of the amount budgeted for the year remaining. While expenses to date for the majority of contracted services are in line with the amounts budgeted, we will note that the significant divergence in budgeted versus actual is in the legal services category, where only 12% of the amount budgeted for the year has been spent. According to legal, I'll rely on them, but they anticipate a significant increase in legal expenses in the second half of the fiscal year as litigation activity picks up in a number of ongoing cases. That's all I had for the budget. If there's any questions, happy to take those.
All right. That end your presentation?
Yes.
All right. Thank you very much. Next, we have strategic plan update. That's page 45. And I'll ask Mr. Owens to present for us here.
Thank you, Bill. Good afternoon, members of the board. One of the things that we've been asked to do and charged with doing is to establish some strategic plan initiatives for CERS. Now that KPPA has moved their ball forward on the strategic planning process, we're able to integrate what we want to do into the 4 bucketed items that they have identified. Rebecca Atkins has been identified by KPPA as their strategic plan champion. So we will work with Rebecca to understand how we can get those items that are important to us from a strategic planning process incorporated into the overall strategic plan. From a timing standpoint, our goal will be to have this process completed by the end of this fiscal year. And that will be somewhat dependent on the rate and the speed at which KPPA moves. But you can see, as is on the board now, from the Finance Committee, those areas that we thought fit neatly into the 4 bucketed areas that have been identified by KPPA.
Any questions regarding the Finance Committee strategic planning process?
What
and
is
the goals?
What is an escalation policy?
As we...
Go ahead.
No, Bill, if you want to take that, that's fine.
No, back to you, Mr.
As we talked about processing, and we were just talking about waivers and that sort of thing on penalties, we wanted to see whether or not there needed to be a process put in place over a certain threshold dollar amount or over a certain number where that would be escalated to another decision-making point. And we'll look to work with KPPA to find where that right escalation point is, but we want it to be clear in the policies and procedures that there would be a point that we thought a matter needed to be escalated to another decision-making point.
Thank you. Any other questions?
Dr. Hackbart has his hand raised.
Oh, I'm
Yes.
sorry. That was a mistake.
All right. Well, if there are no other questions, that concludes the Finance Committee report. Thank you.
Thank you, Mr. O'Mara. The next item on our agenda is our Joint Retiree Health Plan Committee report. Mr. Powell, I'll hand the mic off to you.
I'm going to run the Joint Healthcare Committee team because I'm having a little trouble here. I fell the other day and it's hurt a little bit to talk. We had our meeting on February the 15th, and all the information that was presented that day, no action was required. Ms. Pettyjohn, could you pick up from there, please?
Yes, sir. Humana came, and this is the time of year, February the 15th, that they go over their customer service experiences, and those are issue resolutions remaining high. They reported at 61%. We do get a specific report by quarter for performance guarantees, so we look at that, and then they give us a yearly update in this committee. It looks like, you know, they do have hold times, actually an improvement of 93% over 77%. And their net promoter score, which is 72.86, with anything above 50 being considered as a excellent. Now, there's some changes possibly to the premium going forward for 2024 notices for plan year 2025. A couple of things. The Inflation Reduction Act that was passed by President Biden a few years ago, part of that's going to come into play in 2025. The out-of-pocket for prescription drugs for a retiree is going to go down to $2,000. Then the plan is going to be covering it after that. This year, for example, I'll give you an example of the difference. It's $8,000. So you're going to see that impact when we do the renewal. And then the Centers for Medicare and Medicaid Services put out the bids every year in February, with a final notice being given in April. And they give the plans and the groups time to ask questions and give feedback about the proposals between now and, well, February and April the 1st. And so people are reacting, and there's information out there that looks like maybe the going forward might not be as the amount of money that was expected, but again, they are listening to comments. I don't know, Humana, if you want to say anything else around this area, or if there's anything you can say. We really don't know the final, and like I said, until April the 1st. We do know that that Part D for the Inflation Reduction Act is going to have some sort of change, but it's basically on your what your offering is to retirees currently. So that's going to be factored in. So we're looking for those to come to us. The renewal will be probably July. We may get a heads up in June. Definitely we'll have some information in our May meeting. Larry or Tracy, is there anything I'm missing on that area there? May not be.
Hey, Larry, it looks like you're talking, but you might be on mute.
Oh, okay. Sorry.
And it looks like you unmuted, but now I can still not hear you.
Can you hear me now?
Yes.
Yes, sir.
Yeah, sorry, first time. Yeah, I mean, Connie, I think you're generally correct. We will know more for the May committee meeting and board meetings. The Inflation Reduction Act, while enriching the benefit for the members. It's a good thing for your membership. It is a significant. It has the potential to be a significant cost driver on premiums for 2020, starting in 2025. So we are, watching that closely. There's a lot of clarification from CMS that we are waiting on, and we may not get that until into the summer for some components to this. But we'll keep the board and staff up to date as best we can. And as Connie said, on the advanced rate notice, we'll get the final rate notice April 1st, and that will help us understand. Basically, that's the CMS reimbursement part of this whole equation. And so we'll know more. We're in the early stages on a lot of this, and we'll know more as we get later into the spring and summer.
And thank you, Mr. Lowe. And Humana also gave us a heads up for their 2024 STARS campaign, which is a lot of quality measures that Medicare includes in their contracts with the vendors like Humana. Things that they're going to focus on is the annual checkup for retirees, the risk of falls, so prevention for that is very good information. Of course, the colorectal and breast cancer. Diabetes exam is pretty much an every year, and kidney disease because it's such a disease burden across the nation. And of course, blood glucose levels. And I guess if Humana could give us an update on the Baptist health contract, I don't know if anything's changed since the 15th of February. Mr. Lowe?
I have no material update. That is, we are still actively working towards a new contract with Baptist, but we do not have a final agreement just yet. As we know that KPPA members are continuing to access Baptist on an out-of-network basis with no access to care issues and no change to their cost share. So we're hopeful that we will get a new deal done, but in the interim, it really doesn't change the experience, so to speak, for your membership. But we want to get that deal done just to eliminate any potential confusion there. But no material update right now.
Thank you. And I wanted to give you an update on during open enrollment. We did have quite a few more calls answered this year. We didn't have as many web enrollments, but that was because we had a little bit more of movement in 2022 because there was a plan option going away. So about that number, that 7% that you see that we went down, that's about how many that had already transitioned. So that's why it sort of maybe went back down to a normal application. Not that it wasn't good, it still was pretty good, but it just wasn't where it was before. We did have an increase in the virtual appointments and in-person appointments from previous years. And we did have a few more out in the field, benefit fairs and seminars with both the Kentucky Employees Health Plan through the Department of Employee Insurance and with the retiree groups that covered under the Humana Medicare. So I had that information there. One thing that's not in the memo, well, I just want to say that the Kentucky Employee Health Plans are out for bid this year for plan year 2025. So we'll see information later in the year, probably closer to September around those things. They were not seeking any changes to benefit design, those kind of things is what they assured me of. So I feel like this is just, a general reporting here. If you have questions for Humana or I, please let me know.
Thanks, Tommy.
You're welcome.
Does anybody have any questions for Humana or any of the healthcare team? I hear none. That will be all we have, Madam Chair.
Thank you very much, Mr. Powell. The next item on our agenda is the Investment Committee report. And Dr. Hackbart, you have the mic.
Well, thank you, Betty. The Investment Committee report is found on page 68 of the board book. The Investment Committee has met twice since the last meeting of this group. The first was on January 24th, which was a special meeting, and then we had a regular meeting on February 28th. The committee has 2 action items which are forwarded to the CERS Board of Trustees for consideration and possible ratification. The first item is the ratification of the committee's recommendation to approve the investment of $175 million with Saba Capital, subject to successful contract negotiations. This action, after considerable discussion and review by the committee, was passed unanimously by the committee. The details of the Saba proposal, including the justification for the action, can be found on page 181 of the board book. Steve will discuss the proposal, including the process the staff went through in arriving at their recommendation to the investment committee later in this presentation. As he will note, the major reason for the staff's recommendation to add a manager is that prior to our addition of Arctos, which is the sports investment manager, and CERS, the farmland manager, we only had 2 active real return investment managers, and we have been underweight for that asset classification for some time. The second item that the investment committee is recommending for possible ratification by this full board is an adjustment to our current asset allocation policy. Typically, we undergo a detailed review of our asset allocation policy every 3 to 5 years. However, we did make an adjustment, I believe it was in 2022, but this recommendation, which was passed by a majority vote, only a majority vote, was not unanimous, that would reduce our commitment to public equity, which was increased in our earlier adjustment to our asset allocation policy. We'll be talking about that as well. The backup information for this recommendation is found on page 224 of the board book. The last asset allocation review was held in 2022, and the last full asset liability study was conducted in 2020. The basic asset allocation recommendation involves a reduction in public equity, changing our more recent increase allocation to public equity, and it was noted that in terms of our financial report, it was basically in public equity that we made our major achievements in the last year. We also an increase in specialty credit. Our committee had a rigorous discussion of this overall recommendation because this is probably one of the most important decisions, policy decisions, that we make as investment committee, and we also make as a full CRS board. This change was basically supported by a majority vote, not a unanimous vote. Betty has also provided some observations which are found on page 217 of the board book regarding CRS investment history. We'll have a fuller discussion of the asset allocation recommendation after Steve's performance report and other discussions. During the February 28th meeting, the committee also heard reports from David Lindberg regarding the economic and capital markets issues and trends. He indicated that the market was no longer expecting the Fed to cut rates up to 6 times during the 2024 calendar year, and more recent Fed comments suggest that they may only make 3 adjustments during this calendar year of 2024. Steve provided a report of the portfolio performance for the first half of 2024 fiscal year in the February 28th meeting. The committee also raised some questions about the private equity portion of our portfolio, which had underperformed the benchmark in recent time periods. We also discussed the dollar amount of core fixed income assets that we removed from Lower Abbott and a percentage of that allocation which is being brought in-house for the staff to manage. I would now like to turn it over to Steve for a summary of the quarterly report, including highlights that he would like to mention, suggested he would provide sort of an executive summary, and to discuss and answer any questions that you might have regarding the SABA recommendation. Then I will ask Betty to discuss the review of the historical investment performance that she is undertaking, which is quite informative, before we discuss and consider actions on the staff's recommendation and our majority vote recommendation on asset allocation policy. One final item, Ed Owens is also making progress on our committee's portion of the strategic plan that he reported on in terms of the Finance Committee. We don't have a specific report as we had the full committee meeting at our last meeting and didn't really get a chance to have an in-depth discussion of the progress and recommendations that Ed is making regarding our strategic plan. So with those comments, I would like to turn the program over to Steve for his performance report and also for a discussion of our recommendation of an additional fund manager for real income. Steve?
Thank you, Dr. Hackbart. And as Dr. Hackbart mentioned, he asked me to cover this section as briefly as possible so we can focus on the action items on the agenda. I'm sure everyone's aware that brevity is not my strength, but I will certainly try to do my best. Sherry, if you could go to page 96, please. Thank you. As Dr. Hackbart mentioned, markets across the board rebounded sharply during the second quarter of the fiscal year on optimism that earlier and larger cuts in interest rates would usher in a Goldilocks period of steady growth, moderate inflation, and easing financial conditions. The CERS and CERS hazardous pension portfolios performed well during the quarter with returns of 6.78% and 6.85% respectively. The insurance portfolios produced similar levels of returns, with the CERS portfolio returning 6.87% and the CERS hazardous portfolio returning 6.71%. All of the portfolios outperformed the benchmark, which returned 6.45% during the quarter. For the quarter, the largest contributors to outperformance were the underweight positioning in real return in private equity, as well as the relative outperformance of the private equity portfolio. As Dr. Hackbart mentioned, over longer periods of time, especially if we look at that 1-year period, private equity has underperformed that stated benchmark. And this is the acknowledged mismatch between what we're investing in private equity and what other plans are investing in private equity. And this benchmark, which the Russell 3000 is a public equity benchmark, plus 3% on a quarterly lag. So there's always going to be a timing mismatch as well as an asset mismatch to that benchmark relative to the actual investments in that private equity portfolio. The most significant detractors of performance was underperformance in the for the quarter was underperformance in the specialty credit portfolio. And that's especially evident as the mandates with structured credit and mortgage-backed exposures were drags on the overall performance as they failed to keep pace with the rally over the last 3 months in public high-yield bonds and public loans. January performance was finalized and released last week and reflected soggy market conditions that we all saw during the month of January as returns were mixed across asset classes. The portfolios were up between 10 and 14 basis points for the month, while the benchmark was up 1 basis point, so essentially flat for the month. For January, U.S. large cap equities, especially growth, posted positive performance, while small cap and non-U.S. equities struggled and posted negative returns. Core fixed income was modestly negative as rates inched up during the month. Real estate continued to struggle and was the worst performing asset class for the month, and specialty credit continued its rebound and was the best performing asset class for the month. February performance is still very preliminary, but all of the portfolios are indicated up between 2 and 2.5% for the month. U.S. large cap equities continued to pace markets with posting the best returns for the month of February for any asset class. Non-U.S. equities and small caps rose, but failed to keep pace with U.S. counterparts or cap counterparts. Core fixed income fell as rates rose, with the 10-year U.S. Treasury yield rising 34 basis points during the month of February. High yield and leverage loans rose modestly during the month, given their lower sensitivity to rates, and commodities fell during the month of February. Page 110, please. Thank you. I did want to provide a couple of the highlights from the first half of the fiscal year for the period ending 12/31 of 23. And as Dr. Hackbart mentioned, across a number of legs, staff was able to rebalance the core fixed income portfolio, closing what had been our tactical short duration position. And that essentially moved the duration of that overall core portfolio from 3 years short relative to the duration of the benchmark to essentially flat by the end of the year, or by the end of the second quarter. That entailed a total of $1.9 billion was transferred from the Lord Abbett short duration credit portfolio, with $996 million going to the existing core portfolios, the two managers, Loomis and Nissa, and $928 million going to an internally passively managed core portfolio. To highlight, again, this was the Lord Abbett positioning worked out well on a relative and absolute basis. The performance was strong for the portfolio, and the contribution to the overall performance of the systems was fantastic. That tactical short position that I mentioned in the core portfolio outperformed the benchmark by 381 basis points over the last 3 years. Equating that to dollar terms, that's about $300 million of outperformance because of that tactical short position in the core portfolio that was accumulated over 3 years, and that's across the system. So that's across pension and insurance, KRS and CERS. The 6-month performance was impacted by the rebalancing positively. So if we hadn't rebalanced versus rebalancing, we were up about 160 basis points for the first 6 months of the fiscal year, as opposed to what performance would have been if we had not rebalanced. The addition of the internally managed portfolios is anticipated to save between $1.5 and $2 million per year in fees. Specialty credit managers continue to find compelling opportunities in the space, deploying over $150 million during the period, including the first capital calls for the newly approved Adams Street Fund and co-investment vehicles, which were approved in 2023. A total of just under $300 million was called and invested by our new real return managers, the majority of which was the initial investments, as Dr. Hackbart mentioned, for Arctos, and the other was Maritime Partners. Again, those were approved with CERS, the farmland manager, in 2023. And during the first half of the fiscal year, the first proxy voting report was posted to the KPP website, so we're happy to report that we're in line with the requirements and statutes. I'll pause there if any questions. If not, quickly, Sherry, jump to page 143, please. I did want to highlight the new compliance report format. We continue to expand it and really look to increase transparency, ensure that the IC and the board have all of the information needed to fulfill their governance responsibilities. And I did want to note on the new report, we had 2 areas that were not in compliance as of the end of the quarter. The amount of public equities passively managed by KPPA staff exceeded the 20% limit of the IPS by the amounts noted here on page 143. This was what's considered a passive breach and was a result of market appreciation of the internally managed passive public equity portfolios. Again, those portfolios are focused primarily on U.S. large cap growth, which has been the best performing asset class and sub-asset class over the period. We've used broad rebalancing in the public equity portfolio to decrease these amounts, and we'll continue to use rebalancing trades to bring the portfolios in line with this constraint. We anticipate that'll be finalized by the end of the current quarter. Additionally, the portfolio allocations, as we've talked about on a number of occasions that were not in compliance, are also noted on the compliance report, this time 2 pages forward. One more page, Sherry. There we go. So noted by the amounts noted. This is something we've highlighted every quarter at the investment committee and the boards. This is part of the asset allocation discussion that we're going to have in a moment as well. But we thought it warranted being highlighted specifically on the compliance report. I'll pause there for questions.
Any questions, Steve? Okay, please proceed, Steve.
If not, we can go to page 181. And this is, as Dr. Hackbart mentioned, at the CERS specially called investment committee meeting on January 24th, the committee approved staff's recommendation for CERS to invest up to $175 million in Saba Capital closed-end fund strategy as part of our real return allocation, and that's pending successful contract negotiation. That 175 will be proportionally shared across all of the CERS portfolios, pension and insurance. As we previously discussed, the real asset or real return asset classification encompasses a very broad and varied landscape of investment opportunities. To fill the portfolio's allocation, we seek investment opportunities not only with lower overall correlations to the more traditional asset classes in the portfolio, but ones that are less correlated with what we talk about as the drivers of performance. And that tends to be, especially for public equities, that growth component. We believe that this investment opportunity offers a unique opportunity that satisfies our criteria for the asset class with differentiated source of return, asymmetric payoffs, and favorable standalone risk adjustment return profile. I'm going to have Anthony cover the executive summary of the slides we put together and then answer any questions.
Yes. Hi, everybody. Yes, the next slide over is on the real return investment process. If you go to the next one, Sherry, please. Thanks. So this one discusses how the process starts. It's the way we look at things in alternatives is generally an ongoing one. It's not a point in time where we just are like, okay, we're going to look for this one specific strategy right now and see what is around. We get solicited and meet managers in different investment strategies every day, and obviously at conferences and other places. Saba was one that I met back in 2020 for the first time. I've heard of them prior to that, but we've also, besides this closed-end fund strategy that we started looking at because the discounts are so wide. The team, we've also recently evaluated dedicated commodity strategies as well as listed infrastructure, since we thought that those might be, the listed infrastructure might be an inexpensive way to get exposure to some inflation-sensitive assets without having to tie up our capital for even longer than private equity, because the infrastructure assets can be 20 plus years. So we didn't find anything at this time to present, but it's an ongoing thing that we're constantly evaluating. So the next area is there things that we're looking for in this particular part of the portfolio. Favorable standalone risk-adjusted returns. We want them to be different and or better. So you can get risk inexpensively in other parts of the portfolio. Joe, Brian, and Steve can get public equity and fixed income very inexpensively. For this part of the portfolio, we wanted to provide different sources of return and also ideally some sensitivity to inflation and contracted cash flow streams, because that tends to happen in a lot of what's traditionally thought of as real return assets. So that's the Saba strategy also provides that, given that the funds that they invest in tend to have distribution yields that are pretty high in general, depending on the strategy, especially fixed income ones and other dividend stocks or other underlying assets they may have in them. So as we found the strategy, we wanted to see what else was out there. So we evaluated about 8 or 9 other strategies and managers to compare them. And so we can go to the next slide.
Anthony, before you leave that process slide and go into Saba details, I've got a couple of educational kinds of questions.
Of course.
What's the difference between a real return asset and other asset classes like specialty credit, private credit, or real estate?
Sure. I mean, the lines can get kind of blurry, I would say, Betty. Like there's fixed income underlying assets in Saba, right? So they're going to buy some municipal bond closed-end funds, right? So does that come here? Does that come in fixed income? It's difficult to say, right? We have some private equity funds that are looking at real estate right now since it's been so dislocated, and they have taken those companies over, but it's still in private equity. So for real return, though, I think it's fairly broad, and so there's a lot of different potential strategies. I think if we look at page, Share, if you look at page 192.
Yes, that's a good slide.
Yeah. So these are just a small sampling of things that could go into this and also do go into our portfolio. We do have legacy drug royalty assets, timberland assets. The CERS committee approved, again, investments in farmland and sports last year. And so there's just a lot of different things that can be in this. And so a lot of these, like we were saying, have contracted revenue streams or do move differently than the public fixed income and equity markets. So it really can go a lot of ways. Like there's rail car leasing there. That's a manager I've looked at for about 3 or 4 years. I just didn't find that area to be as undersupplied as the barge area. So, and I've seen a couple other managers actually get in that space, including one of ours in real estate. To go back to what your question was about. the blurring of the lines. So an existing real estate manager that does, I think, workforce housing and distressed municipal bonds, they actually started a railcar leasing sidecar last year. So it kind of
there
gets
is
blurry.
some overlap in the types of assets in the various categories.
Yeah, different people, yeah.
There certainly can be, and I think what we also would highlight is that our asset classification, there's not a universally accepted asset classification. As we know, we've changed category names at different times,
Right.
and whether an asset goes in one category or a different category. I think on this one of the easiest one is listed infrastructure. Listed infrastructure is typically considered a real return asset class. We can have Wilshire weigh in as well, but it's composed of publicly traded equities. So does it belong in the public equity category? Well, what we're looking at when we look at real return or real assets and something that fits in here is some of those distinctions that Anthony highlighted as to what are the driver of returns, what are the sensitivities, is it going to have an inflation and a cash flow component to it? So there can be an asset can be classified, and we've seen it over time with assets within our own portfolio moving from one classification to a different classification. Or when a classification goes away. Remember, we had absolute return at one point, we had opportunistic at one point,
right?
And those assets got reclassified as something else. So at the very highest level, we tend to think, there's equity, there's fixed income, and some of that fixed income, whether it's specialty credits, could fall into this category, real estate debt. Does real estate debt go in real estate? Does it go in fixed income? Does it go in real return? It can be the case can be made for different things. So there will be some crossover between these asset classifications.
Well, I noticed in the SABA analysis that you had looked at the correlation between these closed-end funds versus some of the assets in our other classes. So it looks like you've looked at the diversity issue. The other question I had is, how does a real return asset protect us on inflation?
Real return assets tend to have a sensitivity to inflation. And if we look at this chart again, one of the easiest, we all know commodities, gold, and tips. Tips has the most direct, right? Because there's actually an inflation component to the calculation of the yield and return on tips. So if inflation is high, you tend to want an asset that's going to appreciate with that inflation. And so it's more an inflation, a protection from inflation is a bit of a misnomer. It's more of a sensitivity to inflation.
Okay.
So it has a sensitivity component to it.
All right.
Anthony, maybe you could also, as you discussed with our committee, the fact that the trading at a discount and some of the reasons for the discount trade.
Sure, yes. Let me go back to the slide for that. It would be... Let's go to page... to page 196, Sherry, please.
I apologize. I could have asked you earlier and you went ahead.
It's okay.
Okay.
Or maybe, well, yeah, okay, sure. Actually, let's start at 194. Sorry, 194. What are the closed-end funds? Okay, so closed-end funds, they go public just one time, and they come out with a strategy. So we're going to invest in municipal bonds of this kind, or we're going to invest in green energy stocks, or something that they want to put in a wrapper that may have a little assets are a little less liquid for whatever reason. And so these funds tend to get sold to the investors, which is usually retail individual investors who tend to buy these funds. So then there can't be a run on the fund in terms of like everyone withdraws their money because it's a closed-end fund. But what happens if somebody does want to get out is it's just a buyer versus seller imbalance of supply and demand, because there's no one coming in to buy XYZ closed-end fund, unlike say Nvidia stock or Facebook, or if it's really hot, no one's coming in to buy it, whatever closed-end fund there is. So if you want to get out, most likely you're just going to sell at a discount on the listed market. And so even though the assets that this fund has bought could be liquid stocks or bonds or things that can be easily valued or are valued every day, the fund overall the box you can see on the slide might sell for 90 cents or 95 cents, even though the things in the box might be worth $1, because that's just what, the price you have to accept to get liquidity. And so that's kind of what happens in closed-end funds. If you go up 2 more pages to 196, you can see a chart over time. The one on the left shows that generally closed-end funds trade at discounts. There are exceptions. There are some that actually trade at premiums to the assets that are in the box, either because people think the manager is good or they are excited about it's a way they can get access to the assets that they can't otherwise. But in general, they trade at discounts. And then the yields are there because structurally they need to distribute income. And so that's what occurs, just kind of like your regular open-end mutual funds. The next page shows that these discounts are historically wide. And that may also be, some of that could be attributed a lot to the rise in interest rates, which have caused some mark losses in terms of the muni bond ones. Obviously, some of the funds that have maybe some more tech related or other companies where the valuations were a little more growth sensitive, that's come in. And so, so people have wanted to sell as a result, as they've seen maybe some losses on their statements or things like that. So the imbalance has gotten a little wider, and that's why this opportunity came on our radar, because and for Saba too. I mean, they've traded in closed-end funds for over 10 years now, but the discounts, have varied over time, and this is among the historically widest discounts they've had. So.
Good, thank you.
Sure. Thanks.
Any questions regarding that issue from anyone? Clarifications? If not, please proceed.
I have a couple of questions, please.
Please. You may ask your question.
Oh, okay, I'm sorry to hear it. What is the difference between a closed-end fund and a mutual fund?
Sure. This is a closed, it is a type of mutual fund, but it's closed in terms of they're not going to create any new shares for people who want to buy or sell it, like an ETF does or your regular mutual funds do. In this case, the amount of shares is what it is. So that's why the supply demand imbalance occurs, because the fund manager doesn't have any obligation to help you get in or out of it by creating shares. You just need to get out, and whatever the price the market's going to bear is what you can get in or out of.
So there's no creation or destruction like you would see with an ETF. The amount of shares are static, and then those shares change hands. And to Anthony's point, based on that supply and demand is whether a closed-end fund share will be trading at a discount or a premium to the net asset value or the value of the underlying assets themselves.
See, that leads to my next question. In the literature that we provided, there's a statement that closed-end funds are sold and not bought. But how can you sell anything if it can't be bought?
Sure. With that, you want to get to see?
Yeah. I think what the intent is there is they're transacted, they're bought and sold. Individual investors typically, but it's not typically demand driven. Whereas you may go out and want to buy a publicly traded ETF or mutual fund, and you say, hey, it's a great idea to be in XYZ. These, and again, this is not official, but how closed-end funds typically are traded is that they are sold to investors. Like, hey, this is a great idea. There's an agent that is, or an advisor that is I hate to say pushing, but is selling a certain asset to an individual investor. And again, as Anthony pointed out, most of the investors in closed-end funds are not large institutional investors. It's small mom and pop retail investors that are putting it in retirement accounts or personal accounts. And so that it's the directionality of where the demand comes from. There's not really a demand coming from investors as much as it's being sold. And again, one of the reasons that the firms that manage these funds is it's a very profitable business. Closed-end fund business is a very profitable business for the managers or the sponsor of a closed-end fund.
Steve, wouldn't it be fair to say that the initial offering, when they first come out, that's a sale? Those are sold to investors.
those are sold to the investors. And then those shares, again, closed-end fund shares can trade hands every day, right? As long as there's someone looking to sell or someone looking to buy. And that imbalance of, if you want liquidity and you're selling NVIDIA shares, you're transacting at whatever the current market value is, and that's your liquidity. When you're selling a closed-end fund, a share of a closed-end fund, the price that someone's willing to accept is the price that you transact at. And that tends to be not as deep of a market as what you would see for individual stocks or ETFs.
Two things I'd like to point out. Most cases, your closed-end fund don't have active management, correct? When you buy a closed-end fund of a portfolio of whether it be municipal bonds or growth stocks or whatever, typically that allocation or those holdings do not change in the life of the closed-end fund, correct?
I don't think that's accurate. I think there are active managers, but they're not necessarily dedicated. Like the person who's running the BlackRock Innovation and Growth Trust is also running some other BlackRock equity product. That's why part of what Steve said in terms of how profitable it is, isn't a high marginal cost for them to run it. They already have people there running similar products in terms of equities. But yes, I think they do. It isn't like I think some of like the passive ETFs where they balance to mimic an index. I think these folks actually do make choices of what they think is compelling to buy.
And the second thing, which we dance around the edge, we're talking about these funds selling at a discount. The investment here, as far as what the theory behind what you're talking about, is unlocking that discount by legal action.
By negotiation, legal action, and as we've seen specifically with Saba, sometimes when they get involved in that, and you're exactly right. The big trade here, essentially the big value in this trade is buying something, as Anthony says, at 15 or 20 cents below the asset value, and then unlocking that discount and then getting 100 cents on the dollar for what you have. The means of doing so typically require, again, that the manager is not incented, and the manager, the sponsor of the closed-end fund, is not incented to do so. So investors like Saba, through litigation, through negotiation, or as we've seen in cases with them, just them getting involved. Right. I mean, they know that the manager, the sponsor knows the end game here and what they're trying to accomplish. And the fact that Saba has been successful in doing so when they set their sights and they start to take a position in a closed-end fund, it may not necessarily go to litigation. It may be that they're able to collectively determine steps that are going to unlock that discount.
So if you invest in these closed in, there's a maturity date, I assume, isn't there? They're not, or is that flexible?
Yeah. They're indefinite because I mean that without any action, the fund will just keep going because Goldman or BlackRock or Aberdeen will just continue to collect the fees on the assets they have. So no, these are just ongoing funds.
Yeah, you have closed-end funds that have been around for a long time.
But you could have closed-end funds with maturity dates as well. Closed-end in terms of no addition. No,
the fund manager can turn it off like tomorrow. They can hit I think Boaz, the fund manager, often says if you listen to him online, he's fairly public because this is it is somewhat of a public strategy in terms of trying to convince the managers to do the right thing and not be hypocritical about their governance. Let's say, so they just you can look at slide 214. So in that case, that was an example from last year where there was a Goldman Sachs MLP fund, and they were holders of it. They show up on the shareholder roster in 2022, and they're on there for about a year, and then Goldman just liquidated it because they're the manager. They can merge it with another open-end fund, or they can just choose to liquidate the assets, right? Because if the whole box is trading at 85 cents, but you take all the things out of the box and just sell them individually, and they're worth $1, then you close the discount right there. So in this case, Goldman just liquidated the fund. And that was it. They didn't engage them. They didn't sue them. That one just liquidated.
So if there's no fixed maturity, then you may or may not realize the benefit of purchasing at a discount. Well, that's
exactly right. And so that goes back to, I think if you go to page 202, you can see one of the more recent ones that they have just filed against is a manager called ASA, which is a gold and precious metals fund. And so I just took it to Bloomberg. Bloomberg has a NAV function, so you can see what the discount has been over time, because these are public, right? They trade every day, so you can track what the discount is. So you can see here, 5 years ago, I made this last month. So 5 years ago, the discount was around 14%. And then this year, 15%. And you can just see is the line has just kind of stayed above 10% or whatever. And so the fund doesn't have a date of maturity. It just keeps going. They keep holding, the gold or silver or stocks or the physical or whatever they have in there, and it just keeps going. They've collected all their fees for 5 years now, and the discount remains at, the fund still trades at 87 or 85.
So the underlying investments, the closed-end strategies themselves may not have, but our investment is looking for a time horizon in which to close that. And again, they're not, like any investor, they may not be successful in every strategy they undertake. They may realize, this one's not going to be successful. They cut their losses, they move on to the next one. But unlocking enough of, 12, 15, 20% discounts can add up pretty quickly. And that's part of the cash flowing that Anthony talked about. In this case, if we were an investor, and this was a holding of our strategy, the prior one where the fund was liquidated, obviously the return of all our capital comes back. Plus, if we bought in at 85 cents, we get $1 back for every 85 cents we invested.
Can I ask a question?
Sure, please go ahead.
I see this SABA pending litigation, and in my understanding, when we looked at this company, most of their profits come from litigation. Is that true?
I wouldn't say that's true. There's going to be returns from the underlying assets, right? So the municipal bonds or the mining companies or whatever the underlying assets are going to have that return, right? So you're going to get the benefits of the underlying assets, some of which are, could be, back to Bay's question, classified as real assets. So that was how we originally looked at it. There were quite a few funds that are in utilities and MLPs and other areas that are a real return. That was about 20%-ish or so of the closed-end fund market. And so we were looking at it originally just for that as a scope, and then rather than hamstring SABA and only restrict them to certain areas, we wanted them to be able to find the best opportunities out there. So that it's all of closed-end funds. But yeah, so you're going to get the benefit of the underlying investments, but you're obviously getting them in at a discount, and then the litigation can help to move the fund manager to close the discount. So it's not a litigation-based strategy at all. There is a strategy called for that. Litigation finance, people try and pitch that to us as credit strategy or something that's uncorrelated with the market, which it is, right? Whether you win or whether someone wins a tort lawsuit, it's not going to be correlated with the S&P and the fixed income. I agree with that. I just don't think that that's necessarily a great strategy for us for many reasons. But the one that you're concerned about is up there too. So this, on the other hand, is an activism strategy about certain securities and has the law on their side, right? The 1940 Act has, they've won the judgments you can see on page 200 in the courts that say, you have to treat shareholders in the way that the law says if you're going to have this listed fund. So, and that's why it is on appeal. Like you can, like page 200 shows 3 of the wins that they got last year, and then page 201, they're obviously those managers are appealing. And then page 202, they filed another one against ASA. So,
Betty, did you have a question?
They're paying both sides of the litigation.
Sorry, Lyle.
Can you ask that again? But can you maybe clarify again? What do you mean by both sides of it?
I said, aren't you sitting here paying for both sides of the litigation?
No, actually, they get their costs reimbursed sometimes in the judgments. So it's I think we put it on. Oh, SABA has. In some of the cases, they've gotten their legal fees reimbursed, and it was actually not by the fund, right? Because unfortunately, in alternatives, sometimes that happens, right? We do pay the other fund's lawyers to negotiate against us or do other things. In this case, the actual fund manager had to pay out of pocket, so the investors, who are often, like we said, the individual investors, did not have that come out of their assets. That was, BlackRock or whoever, whatever manager paid that out of their own balance sheet and not from fund assets. So that's for more details on slide 199. So we asked about the litigation expenses that there have been, but for over several billion of assets, it is not a material expense of the strategy.
I know Wilshire was not asked about their opinion on this investment as to A, the investment itself, B, whether it fits into real return or not. I personally don't see how it's real return, but that's obviously debatable. But I'm curious to know what, at this point, whether Wilshire has looked at it and what their thoughts are on it in comparison to other real return assets or investments.
Yeah, sure, Lyle. I'll just take that. So the investment, we did not source the investment and fully underwrite it. We provided, Anthony had requested a summary from us, which we provided, but we just haven't gone through the full underwriting of this particular strategy. So can't really comment on it too much in that regard. It is not, we know the group and we've written about that in the strategy. It's one that we're not yet investing client assets in, but that doesn't mean that we won't at some point. That just means, we haven't taken this strategy further into our due diligence process.
Okay. Depending on which asset allocation number you're looking at, I think we're currently at 4% allocated to real return. I think our target currently is somewhere around 13%. If we make the adjustments that we're talking about in the asset allocation, that number would come down to 7%. So depending on how you calculate it up, this investment at 175 million is somewhere going to show up at somewhere around 20%, one way or the other, of the real return allocation. That seems, for something that is marginal as far as a real return investment, doesn't seem like it adds a lot of diversification to me.
I think the biggest diversification here is that it relies on a different source of performance drivers. It doesn't have directionality similar to many of our investments. Regardless of the direction the market goes, the ability to unlock that discount still exists. So it's not directionally dependent like others. It has a low correlation to existing assets. So it meets, in our view, it met many of the criteria. I think what we have is, so if we have roughly 7%, right? I think we're targeting 100 to 110 basis points of exposure across portfolios for this.
Didn't we ask this question in the investment committee? And with regard to what you just told me, we wouldn't anticipate if the market took a 10% dive, we wouldn't anticipate that 10% discount not to go down as well. It may not go down the full 10, but it's certainly correlated to what the underlying assets are. They're not going to stay put.
Well, the assets, yeah, but the discount is not directionally correlated. If the assets go up 50% or the assets go down 50%, that doesn't necessarily mean the directionality of the discount is going to change, or the impact. It could. I mean, the discount could stay at 15%, regardless of what the underlying assets do.
You're talking about unlocking, as it stands right now, 15 or 20% off of a dollar. Or, if the market were to take a slide, being discounted 10 or 15 or 20% off of 75 cents. The point of a real return is diversification away from the market, not a, potential unlocking litigation wise of an asset that may be going up and down along with the rest of our public equities or fixed income if that were the case.
Right. I think the entry at a discount it makes it less correlated too, and then the closing of it, like Steve was saying, it's a different source of returns, so it's not going to be. It just doesn't move along with regular market movements. I understand that, and I think you're right about some of the underlying assets are, they are public. Some of them are public equities, and some of them are listed fixed incomes. But I think the way that the whole investment as a whole performs is going to be different than just start buying index fund equity and fixed income. And there are real asset under exposures underneath it too. There's several energy, utility, other funds, which, as we know, in the days of Magnificent Seven, these are some of this, things like Apple and Nvidia are bigger than the entire energy sector of the whole market. So this is, this can provide some exposure to that as well, and also diversify things.
Anthony, had you completed your presentation or discussion? Was there anything else you wanted to add?
I think that we're happy to answer any questions. I think it was just about the kind of our process, what closed-end funds are, and why SABA among all that, and then our recommendation and what it would do to the portfolio, which I think we just discussed in terms of it would get us a little bit closer to a target of 7% if that's where we end up going. And
Ms. Pendergrass has her hand up.
Mm-hmm.
Betty,
a question about how we make money on this one. If I understand it correctly, we're going to give SABA 175 million. They're going to turn around and buy certain closed-end funds, try to get the discount windows narrowed. But then how do we make money at that point? What happens next?
Sure. So we can look at page 197. So those are some of the funds that they are involved in and are large owners of already on the right. So you buy into those funds at a discount and you hold them, and they're having some actions against BlackRock, Aberdeen, some of the managers that are on, I think the next they're on there's some of those logos are later on in 201 or 202. And so you hold those funds, you get exposure to the things underneath them, some of which are, like Lau was saying, some of them are equities and fixed income, and some of them are, gold miners or utilities, depending on whatever the funds are and what the discounts are offering in the market. And then, so SABA is buying these 80-cent dollars and trying to get them to turn into dollars, in addition to the underlying return that you're going to get from the assets you have.
So SABA decides when to sell one of their closed-end funds after they've achieved their discount goals.
Yes, or if the discount narrows some, right? I mean, sometimes the idea is they want to have a larger margin of safety, but if it narrows into 10 or 9 or something happens, like they might get the manager to do a partial tender, and so maybe the discount closes a little bit, or some other actions. It doesn't all end up in they don't all just liquidate all at once. It's nice when they do, but sometimes they get agreements to partially monetize some of the things for investors, or pay out a larger dividend or something else. And so if the discount closes, then and it's not, and they can get into other funds that are at wider discounts, they may come out of it too.
So they get out of one because they like they've achieved the discount change that they wanted. Do we get some sort of profit sharing? That may not be the right term, but do we get some kind of share in whatever gains they made on that particular fund before they go buy another one? I'm trying to figure out how we make money.
Sure, yeah.
And who
So if we
decides
bought,
when we're making that money?
sure. I mean, if you bought the dollar for 80 cents,
Yeah.
and then it got to 90,
Are we
And then
clear
you still
participants in the individual transactions?
say that again. I'm sorry.
Are we clear participants in those individual
yes.
transactions?
Yeah, this is a separately managed account, so this is not in with anybody else. It's with our own account. It's not going to be influenced by somebody else having to get in or out of the the funds that we're buying. So I mean, or our specific shares. No, they belong to KPPA. I mean, they are already owners of several of these funds, right? They're the top owners in many of these closed-end funds. So, but if we are investing with them, our additional dollars and shares will, hopefully give them even more influence as even larger holders that the managers will have to pay attention to as shareholders.
David, did you have a question? Or did Dave leave? Okay.
Yeah, I think he had another meeting he had to go to.
Okay. Any other questions of Steve or Anthony?
I have a question.
Okay. Please proceed.
In isolation with our investments, this is different. I understand that. It's not entirely correlated, etc. But we also have all this litigation that CES is involved, CERS is involved in. So are we, by buying this fund, we're really buying a fund that has a lot of litigation involved in it, which is, we already have a lot of litigation. So I know when we met and decided to forward this this investment opportunity on, I was in favor of it. But now I think I'm not anymore in favor of it. I think this is not what we need to be doing.
Okay.
Thank
Yeah, I think the litigation is, obviously I think we have a legacy burden of litigation, as KPPA, and, the plans have had that. This is different in terms of getting something that is helpful for investors, right? I think the litigation that we've been subject to as a plan are, of questionable origin or other things, or maybe as a result of actions that maybe none of us would choose to do. But in this case, this is about hoping to enforce regular shareholder rights.
I
and
understand
duties.
this, but still, it is litigation. I know that's not the only way they can make money, as you explained earlier, but it's a significant portion of it. And there are other
it's a part of the strategy
investment
because
opportunities that don't have all this litigation involved in it that we could be investing in.
Okay.
I think it's a part of just in terms of how you view the litigation. Like we have several strategies where there's a lot of legal expenses as well, but it's not a negative thing. That's just how distressed companies are, debt. I mean, every credit strategy we have has an extensive legal amounts to it. And because, there's so much value that's there, and it's determined by contracts, who has the rights to the different collateral and the assets, and that devolves into litigation because sometimes the parties can't agree, right? And so that doesn't. I mean, so we're part of plenty of litigation in terms of that. In some cases, it often doesn't get to that because it's negotiated. But for any credit strategy, or any of our drawdown things, I mean, we keep Vicky quite busy, I would say, because there's a lot of legal to do, and there's
but
the contracts and all that are involved.
But our other assets that we bought, like don't have this litigation a component.
In terms of which ones, I mean, yeah,
I was thinking doesn't have any litigation. That's as far as I know. The transportation stuff with the boats doesn't have the litigation.
There can be. I mean, if people don't agree. I think that there's litigation involved, and it can be litigation involved in all strategies. So, I mean, CERS had one because they had
if you've ever invested in an emerging market debt fund, you're involved in litigation. every time.
Every time.
Comes and goes. And I think, as I said in the investment committee meeting, I'll say here, if there's a right side of litigation, this is the side you want to be on. And this is different than KPPA being sued directly or suing anyone directly. This is, standing up for governance. That's their strategy, is enforcing individual investor rights, which again tend to be the mom and pop retail investors. The participants, in these retirement plans are the exact participants that Saba is standing up for their rights.
Bill, I believe you had a question.
Yes, I wanted to get back to Ms. Pendergrass's question. I was trying to follow how we got a return on our investment. So these dollars are put into Saba's hands for strategic investments. Then they sell or benefit from the liquidity of the underlying assets, and hopefully there's a profit there. Do they then roll that into brand new investments, or does that come back to CERS as a return on investment, whatever the terminology should be? Or does this just keep rolling along until we say, well, we're ready to cash out, give us our premium? How does it work?
It's the second one. So it's not like a private equity fund where it's like you're just in it till it's over. This is, this can be terminated by either side with 90 days notice. And also partial withdrawals can happen as well. We can get up to 25% of our account redeemed with 65 days notice. So yeah, let's say back to the Goldman fund that was liquidated last year, right? So let's pretend the day before they bought it at 80 cents, or they bought $100 worth. So and it was 80, they're $80, but they invest $80 for us, and then it turned into 100 the next day. Well, then they can keep investing in something else, because the account just continues and grows, and until we say, hey, we want some of our money back. And that's like any of the other open-end funds that we have. We can put in for redemptions to rebalance, or to have some liquidity, or any of those things. So we have several managers like that. We have a few real estate funds. Obviously, that's not necessarily a good example, since there's the market's a little bit frozen right now. But other funds, like we have Aramark and some other ones, that if we want the liquidity, we can ask for that.
All right, that helps. Thank you.
So we would be selling our interest at whatever the discount would be at that particular time period. Is that correct?
Any unrealized, yeah, and anything that had not been unlocked, any withdrawal we had. Now they can harvest how they want to harvest, right? I mean, they would probably. I mean, again, they're incented here to have the best performance possible for the systems. That's the alignment of interest that we have with this manager. If we elected to have a partial withdrawal of the account, they would harvest as they saw fit based on the underlying investments.
I see.
I know we asked at the investment committee meeting and we didn't have an answer. Do we have one now as to what the fee structure is on this?
Yes, we do. The fee structure is set. It's going to be the 0.75% of management fees, and then the benchmark is the performance fee is 25% of the profits that are above a blended benchmark. So it's going to be half global mid small cap equities, and then half the Spider Nuveen Bloomberg municipal bond ETF. So they need to prove that they have added value above things that you can invest in before they make profits. That's the idea.
Any other questions?
I apologize, Dr. Hagberg. My internet's in and out.
Okay.
I lost everything Anthony said after a blended benchmark.
It's on page 216, I believe.
Yes, that's right.
So the management fee is 75 basis points, and then the performance fee 25% of that blended benchmark. Performance above that.
Okay, so they get 25. If let's just say that the blended benchmark is 10%. Then, and they're able to capture 15% return. We give up 2.5%, correct?
No, that would be 1.25%. So 15 minus 10 is 5, right? Because the benchmark made the 10.
Yeah.
So a quarter of 5.
They get 25% of that 5% over 10, correct?
Of the upside, yes, the outperformance.
That's right.
Plus the 75 basis points.
That's correct.
Is that expensive or cheap?
It's a lot cheaper than the old 2 and 20 model that we used to see in some. Certainly fees have come down. I think for our view is within the alt space, there is a pretty wide variety, but I think already that's especially on the management fee side, the base fee, we think those are more than reasonable. We think they're low.
Where does the cost of the litigation from our side get paid from? Out of their 75 basis point or out of the principal?
It's out of principal. It's part of the expenses that we talked about on page 199 here. So there are other expenses that are involved, and so that can vary. But yes, that is also part of that's part of the investment.
So it's 75 basis points plus.
That's correct. We see this a lot in our investments. I think Betty was going to talk to it later in her portion, but there's areas where the fees look like they've gone up a lot, but a large portion of that has been interest expense because some of our strategies require or utilize leverage. And so with interest rates going from 0 to a lot more than 0, then folks are still borrowing to make their returns, but the expenses, are a lot higher now. But obviously, again, we're focused on net returns at the end of the day, and so even as those interest expenses increase, ideally returns are supposed to, at least for credit in those strategies, and the returns for those are also increasing. So,
I see your expected return here is 12%. I'm curious to know how that matches up with other real return assets.
Sorry, I lost you. Other real return assets and something I didn't hear the rest of it.
Other alternatives within the real return space. My question, Wilshire, how does that 8 to 12% match up?
From a real return perspective, 8 to 12% would be on the high end for sure. This would be a little bit more directional in nature. So that would be a little bit more of a high octane return strategy.
I couldn't hear you. I'm sorry.
It would be on the higher end, Mr. Cheetah, from a real return perspective.
At the 12% mark.
Correct.
Okay.
Other discussions or questions? Did that clarify for you? Okay. If not, I'll return to Betty. This was a recommendation of the committee, so I guess it doesn't require a motion for any action that we might take. And
you can make that motion on behalf of the committee since it's the committee's recommendation.
On behalf of the committee. Okay, and put it back with you, and then we can return after we take any action on this item back to the regular program that we still have things to cover. Okay.
Okay. Do I have a second to the committee's motion to
Second.
make this investment? Well, without a second,
I made a second.
Mr. Fulkerson has seconded the motion. Any additional questions?
I'm sorry, Dr. Carver has her hand up.
Okay, I'm sorry. Dr. Carver, go ahead.
Yes, I would like to understand, does the full committee vote yes on this? Or did I hear there was some distinction during the conversation?
The committee voted unanimously at their January meeting.
We did so with the clarification. I made the clarification on my end that I wanted it to come to the full board for approval, not get killed at the committee level.
Yeah. I think that was appropriate. It was move it to the committee with some concerns being expressed.
Okay. So sort of the committee approved.
Well, we have a lot more information now than we did before. Probably changed my opinion, quite frankly. So in terms of voting, but hopefully more information allows us to make wiser decisions.
Right. Yeah, and I appreciate the work that Steve and Anthony have done in terms of answering some of the questions that came up during our conversation. So we do have significantly more information for which we appreciate their efforts.
Mm-hmm. Ms. Rankin, I'm going to ask for a roll call vote on this one to make it a little easier.
Sure, yes, ma'am. Ms. Pendergrass?
I'm going to wait until the end, please.
Okay. Dr. Carver?
I'm saying no because I don't understand it enough.
Okay. Mr. Cheatham?
No.
Mr. Foster?
I vote no.
Mr. Fulkerson?
Yes.
Dr. Hackbart?
No.
Dr. Milkman?
No.
Mr. O'Meara?
No.
Mr. Powell?
No.
And Ms. Pendergrass?
I'll vote no as well. This motion fails. And I'll hand it back to Dr. Hackbart to talk about asset allocation.
Thank you, Betty. And I would invite you, if you would like to, you have done some work in terms of performance over the years. Would you like to make that information available to the committee?
Sure, I'll do this very quickly because I want to get into the asset allocation discussion itself. One of the reasons that I did this is I sat on the Board of Trustees in 2017 when we first started decreasing our asset allocation to public equity and moving it to alternatives, specialty credit, and some other assets. So to me, one of the most important trends that I have noticed since that time is on page, let's see, on page 218, I believe. Yes, the next page. If you look at 2012, and that's the first time we really have data all the way across the board on this schedule. Steve and I have spent a lot of time trying to get some historical information, and some of it's just not available. But in 2012, we had a 9.36 return. We were using a discount rate at that point of 7.75. And if you look down the column, we have decreased our since inception returns between 2012 and 2023 gradually, definitely, but it has come down with some significant decrease in interim years. So yes, we have lower volatility when we take money out of public equities and put it into other assets. But at the same time, we also decrease the yields in our portfolio. The next page highlights both the yields by asset class and the management fees, what it cost us to generate those returns. Specialty credit is one of those that has the highest cost in terms of fees. and compared to the returns that we get now, the returns are net of the management fees. And then Dr. Hackbart had raised some questions about what other systems were doing in terms of asset allocation. So the schedule that I have on the last section, I believe that I'm sorry, there it is, 221. That is just a quick outline. I didn't look at all 50 states. I tried to find states that were close to us in either number of members or plan net position. Try to get an idea of what was happening in some other states. And with that, I'll hand it back to Dr. Hackbert.
Thank you, Betty. Thank you for your efforts and additional work and so forth and providing perspective. So we now will switch our conversation to the asset allocation policy. As I mentioned at the outset, this is one of the most important policy decisions we make as a board, and indicated that typically, at least historically, asset allocation intensive studies take place every 3 to 5 years. And the last one was back in 2020. So we were basically due for a review. And basically, Wilshire has been working with staff on this redo and reanalysis of our current asset allocation. A bit of history, we had an existing asset allocation. We made an adjustment. We increased our allocation to public equity. I think it was in 2022, if I'm correct.
November 2021.
November 2021. We increased our allocation from the prior base at that time. I think that was probably, if we look at the yield or the and return since that time, that was probably a good decision in terms of increasing return on our portfolio. But there are some other factors, times change, and certainly in the review, we want to look at other factors, looking back at historical trends, and of course, also trying to project forward, which of course is extremely difficult to do because we really don't have any information about the future. So we're kind of having to work up past trends and trying to deal with issues of risk and also return those considerations. So I would like to turn it over then either to Steve or David, who's ever going to make the presentation, to just provide some perspective upon the recommendation that we deliberated. As I mentioned, we passed this recommendation on to the full board. Was a majority vote, was not unanimous. And so I think it's important consideration. Again, it's a major issue for us, a major concern for us in terms of our responsibility, because certainly asset allocation is a key factor in what the ultimate return will be on our portfolio. So Steve or David, if you would proceed with presentation.
Sure, I'll give a brief introduction and turn it over to David. As Dr. Hackbart mentioned, the full asset liability was performed in November 2020, and the last asset allocation modeling work was done in November of 2021. Capital market assumptions, as we all know, have changed materially since that last asset allocation analysis was performed. At that time, return opportunities were pretty limited, which forced pension plans, including CERS, to shift out the risk spectrum, as Dr. Hackbart mentioned, and increase primarily to public equities in order to build portfolios that were expected to achieve their actuarial assumed rates of return. The most notable changes since that last study has been the expected returns for fixed income and other asset classes with a yield component as rates have risen sharply from their former zero bounds. These changes in market conditions and expected risk and returns warranted a review of the existing asset allocation and provided what Wilshire and staff believed was an opportunity to construct efficient portfolios with meaningfully lower expected risks and higher Sharpe ratios while maintaining similar levels of expected returns and improving liquidity profiles. These allocations, should they be ratified, would help to mitigate the risk and potential magnitude of significant drawdowns in the portfolios should markets experience large sell-offs, while also improving the probability of achieving the assumed rate of return of the portfolios over the longer term. With that, I'll turn it over to David and Wilshire.
Okay, thanks, Steve. Just a reminder, Chris Tessman is here with me as well, and we'll both speak back and forth on this. I think we'll just try to summarize some of the key slides here in the interest of your time. If we could go, Sherry, to page 226, please. Much of this was just said well by Steve and also Dr. Hackbart. And the fact is that a few years ago, when you went through the last full asset liability study was essentially 3 years ago, a little more than 3 years ago. And then, as Steve said, the asset allocation was adjusted in February of 22. If you go back to that time in 20 and 21, we were at a near zero interest rate level in terms of short-term overnight rates. And that created for us then a regime that was completely different than anything that had been experienced in the prior, essentially, 40 years, because we've been in a rate declining cycle since about 1980. But we got to zero during that time when the Fed had produced so much quantitative easing that the rates had to be brought down near zero. And funds all over the country, like your own, were looking for ways to stretch for some return, and also trying to find tools to hedge some of that growth orientation of the return. And that was very difficult at the time. And you did increase your public equity exposure at that time. The recommended policies that came forward to the investment committee that are in front of you today make some adjustments to that allocation. Well, we'll get to those in just a minute, but the things you can think about are that we've had a complete regime shift from that point 3 years ago to where we are today. And if you start with interest rates, we've moved short-term interest rates up by 5%. So that has a significant impact on everything we expect looking forward for any form of fixed income, whether it's cash or whether it's high quality investment grade, or whether it's the things that are embedded into your specialty credit portfolio. All of those have a very different look about them today looking forward. At the same time, so does equity. So does public equity. And the public equity, if you just look at last year alone, the US equity market was up 26% last year. Over the past 5 years, the US equity market is up over 15%. So what that's done is that has driven equity valuations to extremes. So forward-looking expected returns are lower today on equities and much higher on fixed income and different forms of fixed income. And so all of that has led to the opportunity that you've had, and we talked about this over probably the past 6 months or so, both with some of the board meetings and some of the investment committee meetings, the opportunity to reduce your return, your risk, some without reducing your return. And by reducing risk, we don't just mean volatility, but we mean the potential for the portfolio to experience large drawdowns, large negative returns in short-term periods, and also just how the portfolio is exposed to growth and inflation economic environments. So those things are all important. If we just jump ahead to 229, 2 slides over, and then we'll go into, we have 2 other slides we'll go to just to get into the details a bit. But on this slide, the recommendation of the investment committee was that the board adopt one of the 2 lower risk policies that we spent time working on with staff and with the investment committee after a lot of work, and a lot of that is even here in the appendix of this document. But there was lower risk A and lower risk B. Those were simply labels we gave those policies. B was a policy that lowered the risk more than A. A is the one that the investment committee is recommending. And so in this, we'll go to it in detail in a minute, but you can think of it as this. It's about a 5% reduction in traditional growth-oriented assets, meaning just pure equities. And then it's a significant increase in the specialty credit, which you can think of as also a growth-oriented investment, but not quite the same as regular public equities. And then it's more of what we refer to as a defensive growth kind of asset. So the trade-off that is being made is reducing traditional equities, both public and private, in total by 5%, and increasing the allocation to specialty credit, which is more of a defensive growth asset. It's not a significant increase in pure defensive assets like investment grade and cash. There is a modest increase in the allocation to cash, but it's essentially sort of a trade-off between higher growth and slightly lower growth assets. And it gives you the ability to lower your forward-looking expected returns by about 100 basis points, keeping the expected return at the same level as your current policy, which is 6.95%. So it's significantly increasing that Sharpe ratio, the relationship of risk to return from this policy A versus the policy you have in place today. So that's a summary of that. Chris will take us over to slide 253 and 4, and we'll just break that down a little bit into some of the details.
Thank you, David. So, as David said, the economic regime that we're in is quite different. If we go back to the second quarter of 2000 when we did your last asset liability study, just for some context, our capital market assumptions were quite a bit different in that we were expecting somewhere in the neighborhood of, well, exactly 6.75% from a global global stock. And when we look at our core bond assumption back in the day, that was just over 1%. So we were looking at over a 5% equity risk premium. Whereas today, that's compressed quite a bit. We're just over 100 basis points when we did our ALS study for you this go around. So there's been a significant shrinkage or compacted equity risk premium, and that's reflected by what you're seeing moving from the current target to lower risk A or lower risk B. But we're going to focus on this middle column, which is really driven by the constraints that we had to put on the optimization, because one of the things we did not want to do is oversteer the correction in any equity allocations here. Any optimizer right now, given the assumptions that we have, is going to look at other higher Sharpe ratio asset classes as a more attractive trade. So when we work with Steve and the rest of the staff at looking at the asset allocation study, we actually determined, we put floors on the equity that we were willing to move, and we did that in varying levels of increments. You can see lower risk A had an optimization constraint of 45%, and then we allowed private equity to move between 0 and 10%. And that ultimately led to lower risk A having a reduction in the overall equity exposure from 60% to 53%. So a 5% reduction in public equity and a 2% reduction in private equity. Then when we look at the fixed income bucket, which David alluded to earlier, having specialty credit, which we modeled as a 50-50 allocation between private credit and high yield or public high yield credit, that came out to be a 10% core fixed income allocation. And think of that as your pure defensive, your core fixed income, your aggregate exposure, plus your cash would be those defensive assets. And the defensive growth, as Will sort of views it, is that specialty credit. That's taken the largest leap forward from 10% to 23%. And a lot of that is just where that specialty credit, really driven by the private credit component of that, is being driven from the assumption perspective. That's a really attractive trade right now, as many of those loans are going to be floating rate loans. So they have a direct kind of tie to that inflation or that move up in the yield that we've seen in fixed income markets. So your total fixed income allocation would move from 20% to 35%. And then there's a slight reduction both in real estate and real return, from 7 to 5 for real estate and 13 to 7% for real return, bringing you much more in line with where the portfolio is actually positioned today. So overall, if we were to look at the expected return from a 10-year perspective, you can see from the current target to lower risk A, we've actually maintained the expected return over a 10-year basis. And on a 30-year basis, it's marginally reduced by 12 basis points. But if we look at the standard deviation of return, we've actually reduced the portfolio over 100 basis points in expected risk levels. And the Sharpe ratio, which is the last line, we've actually increased the efficiency of the portfolio from 0.24 to 0.26. So going back to some of the performance presentations that Steve has done for you recently, that's one of the charts that we look at is really how efficiently are we using our risk budget. The Sharpe ratio is a great measure of that, making sure that we're getting the most return for every unit of risk that we're allocating. If we move to the next slide, you can see here again those kind of summarizations of the different asset class bucketing. But more importantly, if we move down and we look at the contribution to asset volatility, we are moving down a little bit from the equity. We're taking a little bit of equity exposure away. Fixed income is moving up a little bit. The yield on the portfolio is increasing fairly significantly. The growth factor is coming down, so we're not quite as tied to the growth factor as measured by Wilshire's economic growth. We do have a little bit less of an inflation buffer, but the overall liquidity of the portfolio in both what we call market or stress time periods for lower risk A is improved in both scenarios. So overall, we're able to lean into the higher yield environment in a fairly significant way to be able to increase the efficiency of the overall portfolio, given various different factors that we're looking at. Happy to take any questions from any board members. I see
Bill Mayer has his hand up.
Please, Bill.
Bill, you're muted.
Okay, I'm sorry. I was hoping that you would add a schedule in here that would show our current allocation compared to our current target, and then the proposed risk A, risk B.
We have that, Bill. Sherry, if you can go to page 222. I took the Wilshire schedule and I added 3 columns. First column I added is the current since inception yield as of December 31st. The next column I added is the current allocation percentage of the portfolio. And then on the far right, I added the Wilshire 30-year yield projections. Is that what you had in mind?
Yes, it is. Okay. So,
or do we have just a simpler table which just has our current allocation versus the proposed allocation?
I'm not sure we have that slide in here. I know in our performance reports, we have the slider bars that show where you've been overweight or underweight.
I think, Steve, you had one that you distributed, didn't you?
I sent it to you, Dr. Hackbart. I'm not sure if it got distributed. I can send that around.
It provides, I think, a good, basically what Bill's asking for.
I think you can do it though right here with the slide.
Actually, if we go to slide 129, I think that
was that 129?
129. So I think this is going to show you where your asset allocation is today. And you can see slightly overweight public equity, but very, very close to the target. And the target is those black lines. Same thing with core fixed income. Specialty credit is on the higher end. It's sitting around that 20% mark. This new allocation would be looking at 23%. So you'd be very, very close, and you'd be within a band, the new range rebalancing, which we would work on post-approval of the strategic asset allocation. Real estate is slightly underweight currently, but there would be a reduction in the current target, taking it down to 5%. So that blue triangle would be very close to the expected target. Real return is moving down as well. That was up, I think, at 12%, if memory serves. We'd be moving that back down to 7%, so we'd be very close to that. Plus, you'd have private equity, which would be moving that band a little bit further to the left. You'd be more in line there. 8% would be the new target. And then cash, while you do have some cash exposure right now, but but no strategic asset allocation, we'd be moving that over, so you'd be in line with your cash allocation of 2%. You'd be just slightly underweight to that.
Yeah, and these values are obviously as of 12/31. Current values are modestly different, but consistent with those numbers.
Well, this leads to one of my questions. I would like to look at the specialty credit and the real return lines. We're currently in specialty credit a little over 20%, with a target of 10. Real return, we're at 4% with a target of 13. So help me understand how we got to a 20% specialty credit when our allocation goal was 10.
Sure. Remember, on the last asset allocation, a significant reduction was made to the target for specialty credit, which is specialty credits, private credit, high yield, public high yield, and public loans. At the same time, the opportunistic category was taken away, and the assets that were in that category were moved into specialty credit. For real return, the target was increased significantly, and I think you can go back to Anthony's slides on the SABA recommendation as to what the real return target was increased significantly, and at the same time, a very large Putnam 60/40 mandate was terminated. In the interim, we've been utilizing the specialty credit, so it's not additional allocation. We haven't allocated any additional capital. We've been taking it down, and right now we're inside 20. We've been taking down specialty credit, but that's also been serving as the proxy asset class for real return as we look to source additional investment opportunities and deploy capital. As we know, in real return, that we commit capital and it can take multiple quarters. We still haven't seen one of the allocations that was approved early in 2023 call any capital yet. So the deployment of that capital it's a pretty long runway.
So that last comment, 4% shows how much is currently invested, not how much we have committed.
If you look at the pro forma dots on this page, that's where we've tried to show what we think, given the amount of capital that's been committed but not yet called. And we also have capital that will never get called. To some, full commitments rarely get completely called in this asset class. So we do have uncalled capital that will never get called. So we've tried to adjust that. So if as of today, and this is as of 12/31, all of the capital that we had committed that we think has a high probability of being called were to be called, that pro forma would indicate where we would be from a allocation perspective.
I think I get that.
Yeah.
So what I'm hearing Wilshire telling us is be ready for a correction in the equity market. It's at an all-time value high, and that the core fixed income is back on the rise, and yet our core fixed income allocation being proposed is unchanged, and yet the private equity, specialty credit, we're going to match or actually increase from the point we're on right now. So help me understand. Okay, so specialty credit is part of fixed income category. So instead of investing in core fixed income, we're shifting more dollars into specialty credit as a fixed income. Is that the recommendation, as I understand it?
That's correct. And if you look at lower risk A, specifically just to the left of that 23% allocation in lower risk A, you can see that the optimization constraints were 0 to 25%. which led to the 23% being taken by the optimizer in that case. Lower risk B, if you move over to the far right two columns, had a 0 to 20% optimization constraint, and you can see the optimizer actually took all 20% of that. It's a asset class that is extremely attractive to the optimization right now, given our capital market assumptions.
Yep, so I think I'll just add to that, Chris. So the difference between A and B is just a difference of risk reduction and your appetite for the risk. So what we've tried to emphasize over the past several months is that you have the opportunity to reduce risk and have a more balanced exposure without reducing the expected returns from where they are today. Both A and B do that. B just does it more significantly. And as you move out, you think about it like moving out a frontier of risk reduction, then you would start to pick up less of the specialty credit and more of the investment grade fixed income. But both of those are helping to create this scenario. So it's really the difference between the two is more of one about risk appetite.
One thing that struck me is the fact that it's been mentioned periodically that we're at an all-time high. Looking back historically, we've had multiple all-time highs from the 1980s forward, basically because of the expansion of the economy, new growth opportunities. Basically the productivity of our nation's economy is growing. And I think that's probably a major reason why the equity market has grown, and we've had multiple highs. This happens just to be another high this year. I'm not terribly concerned about that. I think it simply reflects what's happening to our macroeconomic situation. And certainly I think the equity market, public equity, basically reflects, in effect, the economy to a great extent.
And Dr. Happer, I think that's a great point to make. We've actually done some internal research here, looking at different bubbles in the market, and by all measures right now, we don't view the market as in a bubble or nearing some implosion or anything like that. So we don't want to definitely be the doomsdayers here. But going back to some of the points that were made earlier about some of the asset allocation projects we've done in the tenure and working with Kentucky, there was an increase in public equity allocation when we did have to reach for some of that return, when there was no ballast or any return coming from the fixed income markets. This is simply being able to take advantage of the new return source in fixed income right now and being able to take some of that growth equity risk off the table. This is not necessarily a reduction in public equity because we think it's overvalued. It's more of a return to normalcy now that we do have other sources of return outside of the growth market.
Yeah, that's a very good point that Chris makes, and I just want to emphasize, Dr. Hackbart, this is also not a tactical view at all. We are not suggesting that equity markets, because they're at an all-time high, you should sell your equity. That is not what we're trying to portray here. Everything we're presenting in the way of capital market assumptions are for the next 10 years, and a lot of that comes from what is the positioning of interest rates today and what is the positioning of equity markets today. All of that is baked into that. So none of this is a short-term sort of tactical play. It is a, as Chris said, taking advantage of those relationships and how they differ today versus 3 years ago. What you have is an opportunity looking forward. For example, you look at fixed income. If you buy it today and hold it to maturity, you have roughly a 5% return. 3 years ago, that was close to zero.
I think we could also look at the expected return. We do have a 6.95% expected return, which is above the discount rate, which is great, because that means you have above a 50% chance from simulation models to hit your discount rate. But you could even, depending on how much of that risk appetite you want to cut back, you can still remain above that 6.5%, legging into other areas. I think lower risk A was the nice comfort zone, if you will, and we had our meeting with the IC and working with staff in making sure that we're not oversteering public equity in such a way that if there was a market correction, we would have to essentially churn the portfolio, going through multiple transactions to decrease the actual exposure, only to have to trade back into it at a later time.
Just another thought, back when we made the last adjustment to increase our allocation to public equity, I think a logical expectation would have been that interest rates were going to go up, which would put pressure against the equity market. We're in the reverse situation today. We're expecting interest rates to decline maybe 3 or 4 times this year, which will put upward pressure on the equity market. How do you explain that?
Well, if you take the assumption that we're near a high on interest rates, then in the short term, as rates decline, if this goes back to the other side of this equation, the fixed income side. As rates decline, prices go up on fixed income. So while we have a 10-year expected return for fixed income, in the shorter term, if rates decline, those returns are even higher because rates are going down, prices are going up.
I would also just add to that, if you were to go back even just a few weeks, I think markets were pricing in 5 to 6 rate cuts over 2024. And I think the consensus now is that the Fed is waiting to see how inflation plays out over the next quarter or so before they make any rate cuts. So it could be a higher for longer rate environment is some of the kind of positioning that we're seeing right now. So I think the market might have priced in more rate cuts than we may actually see in 2024.
Well, and I would argue in November 2021, when the work was being done, while the expectation was eventually rates would rise, I think there was a lot of discussion about R squared or R starred and how long rates would be. I mean, remember the period that we were in. Rates had been ZERP. We were in a zero interest rate world for an extended period of time. And that was much more about shifting out of an asset class that essentially offered nothing, offered zero in the way of return, of yield, and no ballast, right? Because the ballast is in rough market environments, core fixed income is going to be perform well because the market hits the economy hits a rough patch. They're going to cut rates. There was nowhere to cut rates. So I think that was as much driven by the expectation that fixed income had nowhere to go and wasn't going to serve as a ballast in a rough environment and offered no yield. I'm not sure many people back in November 2021 were saying that we're near 5% 10 years. No one I knew was thinking we would be where we are right now. Now, to Chris's point, we entered the year expecting 6%, 6 rate cuts in 2024, and now we're down to 3 with some comments about the next move might be an increase, right? I mean, so it's back into a very fluid environment as to what the rate environment is going to be going forward. If anything, I think the elevated, back to normal elevated rates for an extended period of time is likely to be the reality, especially with the managers we talk to on a day-to-day basis, market pundits, and again, grain of salt those, but the expectation currently as we sit today is that the rates are going to be elevated for an extended period of time. We're not going back to ZERP. We're not going back to zero rates.
I think, Steve, if I recall correctly, and having been involved in that adjustment, we looked at peers across the country, and we were, in terms of our asset allocation to public equity, we were possibly on the lower end, or at least in lower middle. And looking at the performance of our peers, I think a part of our judgment was long term. We were thinking we would be better off in public equity than would be in some of the other types of assets. And that was part of our judgment as to why we increased the allocation to public equity.
Couple quick.
We were not doing it strategically because of low interest rates. I think it was more of a long-term perspective that we were considering at that time, if I recall correctly.
Couple of questions.
Please. I think, did we lose you?
He looks frozen.
It looks frozen. Yeah.
So certainly in excess.
There you are. You're back. Okay, good.
You froze up there for a moment, Mr. Cheatham.
I was asking Steve, David, Chris, the specialty credit market versus, the core bond market. There's a pretty substantial difference in yield right now. You're looking at what, 8, 9, 10% or better in some specialty credit arenas.
Yes. Right.
So, just from a pure dividend standpoint, that's awfully attractive versus an equity option.
Yeah.
I'm left with three takeaways from our meetings prior and now is we're really not making any significant changes to the current asset allocation. You're talking about maybe 2 or 3% on the public equity side. We're basically already there on the private credit side. But we're able to do that and still get the same return expectation going forward and do it with over an 8% reduction in our risk profile. Am I reading that correctly?
8%, as I assume you're taking the 100 basis points, roughly dividing it by the 12+% to get to your 8%. So yes.
Yeah, I mean, because that's what it is.
Yep.
That's what our risk is.
Correct.
Yeah.
So that you get a more efficient portfolio, the same return, not making any significant changes to where we actually are now. What we're really changing is what our policy has been that we're really not in line with entirely. Correct?
Yes.
I think
yes.
that's fair.
More efficient return. And yes, you mentioned at the outset of that, assets won't move significantly. That is correct because you're much closer to these targets than, in some cases, than you are in the current targets.
By any chance, did you all run the risk profile for our current allocation? The 51% in equity, the 20% in specialty credit, et cetera.
The risk profile of that was at 12.82%. So that's back on slide 250.
No, excuse me. That's our current target. I'm talking about where we currently sit.
No, we did not run that to put in here. We did not run the current implemented portfolio. We just used the chart.
That appears to be what is on this page that is in front of us, but I don't believe we ran that, but that shows a 9.51.
I pulled that from one of the investment pages that you had in the quarterly report that shows the standard deviation on our portfolio as it sits.
Yeah, I'm just not sure which
that might be
a
realized number as opposed to an expected number.
Yeah,
I think that's correct.
The realized
yes,
number.
that's one of those piston-like schedules.
Right. Yeah.
That would be comparing apples to oranges.
Yeah. So that's a good way to think about that. Maybe it's helpful to Mr. Amar's question. Your historical, where you've run the last 1 in 3 years, which is where I think what this number is coming from, has been a lower level of volatility than your current target is forecasted at 12.8%. Your actual results have been lower risk than that. I don't know if that helps to answer that question or not, but it's not a forecasted number.
Well, at lower risk with higher public equity, that's interesting.
Yeah, it's all time dependent. It's just based on whatever historical period we're looking at. Even when we look now at other funds that have done extremely well because they've had a lot of U.S. equity in particular, that's very time dependent. And we have about a 15-year period right now. This is what makes this really difficult for a lot of decision makers in your situation. We've had a 15-year period where the Federal Reserves, the monetary policies have created easy capital and has allowed the equity markets to rally with some exceptions, just about continuously. So that's not a normal environment, and of course, that's exactly what the Fed is trying to get away from right now with the rapid increase in rates that they've created. So we have to be careful about looking back and looking at what has driven returns historically, particularly in that last 15-year period. It goes all the way back to the credit crisis.
One thing I'll add to that as well is when you look at illiquid investments, private markets, when you're calculating a risk number off of experienced results, those tend to be fairly smooth. So it's going to underestimate the risk number. When we forecast risk, we're actually looking at the economic risk of the investment that you're taking. So private equity might have an experienced 10% fall, but when we model that, it's going to be much higher. It's going to be upwards of 25, 26%. Mm-hmm. So you're going to get a much different experienced return pattern versus what we think the true economic risk of the investment is.
Good point.
Just to return to Bill's question, the numbers that I have at in the current allocation column for standard deviation and the Sharpe ratio came from page 121 in our board books.
Yeah, that's experienced.
Mm-hmm. So is that what's the time period on that, Chris? Is that 3 years or?
So that
it's
one
a 5-year. It's a 5-year.
Okay. Yeah.
So your risk assessments come off of historical data, right?
Not 100%. Historical data has a lot to do with risk assessments, but there are other elements to forecasting that as well.
I think what Dave's trying to say is one number is looking backwards, and one number is looking forward.
Yeah, that's a great point. In fact,
the forward is a difficult part.
Yeah, exactly.
Right.
That's where judgments come in.
Sure. Yeah, it does, but there are many elements to it that are important when you create forward-looking assumptions. One is the relationships between various asset classes. That's important. Another that's important is that you take into account where things are today. Fixed income, for example, is the most predictive thing you can look at. So 3 years ago, when you looked at the aggregate index, the yield to maturity on the aggregate index was around 1%. That would be about what you'd earn over the 10-year period looking forward if you went in at that moment. And today, that number is in the high 4s. So that's what I mean. The Fed has lifted interest rates by 500 basis points on the short end of the curve. That changes relationships, not just for a short-term 1 or 3 year, tactical kind of view, but as you model assets looking forward over 10 years, that's a significant change in how those assets are modeled. So while it is hard to calculate assumptions, and every provider of that product, that service, as like we are, have a lot of work on their hands in doing that, but there's a lot of robustness to that process. I can assure you of that. So again, this is much about a marginal change in what you have allocated to pure growth assets versus defensive growth assets. It's not a bet against the U.S. equity market or anything like that. It's just a marginal change in taking advantage of what the higher interest rate regime offers you today in terms of how to achieve your expected returns.
Any other comments or questions?
I'm curious, when are we going to do this again? Because if we're doing it again soon, I think no matter whether it's 1, 2, 3 interest rate cuts, I don't see how the market's going to go down. Plus the increase in technological knowledge, and if we're doing it in the long run, especially, well, it seems to be in a path where labor market's doing well, capital markets are doing well, and I don't see why, even though the price earnings ratio is relatively high, but maybe that's.
Well, I think right now there's some concern about the big seven, but at any period in time in our history, we've had certain industries, certain types of productive capacity groups that have excelled others compared to the rest of the market. And so that's just a phenomenon that continues in a capitalistic economy like ours. So
So
there's
that's
been
why I
concern
say
about,
we should maybe change our allocation.
right. You know, there's a concern about the fact that we've had the leaders in the equity market, but we've always had that.
Right.
That's history. Nothing unique about what's happening today.
So let me ask you,
This
do you
isn't a
think
change.
we should change our allocation?
Dr. Milkman, just a second. This recommendation is based on an asset liability study. We generally do that every 3 to 5 years.
Yeah, and it so happens that the market changed materially, right? As been discussed earlier, interest rates going from 0 to 4 to 5 has a significant impact on forward-looking returns, and thus why the recommendation is to, achieve a similar, return that would meet the needs of our members while taking less risk. Because if you guys are right, that's great. But if it isn't, then we have to plan for those scenarios of the world as well. And so having a defensive, yield component and being at the top of the capital structure and still getting paid a return that, meets or even still exceeds our assumed rate is pretty attractive.
I think the IPS specifies that the asset allocation is reviewed without really specifying what that means annually. But our position has always been, obviously, while we look at it annually, I think, market conditions might warrant longer or shorter periods for actually doing a full analysis and modeling work.
Oh, but Steve, if we're doing that, are we making a strategic adjustment versus a long-term adjustment, reflecting the current markets? And it seems to me we need to our vision is the long-term rather than.
Well, that's what we focus on. We're not day trading the portfolio. This is we're basing this on forward-looking 10-year and longer expected returns. That's what we're basing it on. I'm not looking at what gold's going to do next week. We're looking at over the next 10 years. And to David's point, there is no stronger starting point bias in an asset class than fixed income. You buy a 10-year bond, you don't trade it. You know what yield ultimately you're going to end up with in 10 years. So we're looking at that. This is materially changed. I think the magnitude of the change here, certainly over the past 10 years, we have never experienced anything like this. This is significant, and it's significant on what the forward-looking expected returns are. We're not, to David's point and Chris's point, we're not forecasting that equity markets are going to go down 20% this year or 10% this year, or they're going to go up 20 or 10%. What we're looking at is over the next 10 years, what's the expected return of those asset classes? And I think what we've seen is there is a starting point bias to equities. You're right. Over the longer term, there is some outperformance that U.S. equities have had and have benefited from. But what's that expectation for that outperformance going forward? And I think what Wilshire's work has shown is there's a compression of that equity premium that we've seen relative to other asset classes, and specifically those asset classes with a yield component. That's why I think what's warranted here. Now, if there was a dramatic change in market expectations 6 months from now, 12 years from now, I think it'd be worth looking at. I think it would be worth evaluating the modeling again, whether or not we would recommend or Wilshire would recommend making changes. I think that's a determination. I mean, those are assessments that we make on a continual basis.
And Steve's right. If there were big market swings, if we went back to a zero rate environment, we would absolutely want to revisit.
Oh, yeah.
Right. So this is On the flip side of that, we've had very different market conditions just in the past, year. And it just so happens that when we started this process last year, we were basically right on that 3-year mark, which is about the time frame we try to target and make sure that we're reviewing the strategic asset allocation plan.
If we could go back to Dr. Milkman just a minute, I think he had another question for Dr. Hackberg.
I was just, in my mind, and in my private portfolio, which is different, I understand that. But I see for a long term, and it's been true since the Great Depression, equities are have a much greater increase in value than anything else out there. And since we're in a long-term phase, we're not trying to forecast whether the market will go down 10% this year or up 10% this year. If we're talking about for 10 years, then it seems to me where we are is pretty good.
So I'll just respond to that a little bit, Dr. Milkman. First of all, it's important to know that we agree that equities over the long term are expected to outperform other assets, clearly fixed income, clearly since 80 and 100 years ago. We also recognize that there are periods of time, decades long, where that long-term average was not achieved. And we're not trying to time any of this today. We are just saying that with that compressed equity risk premium today, the difference between equities and fixed income looking forward, it's a more difficult time looking forward over these 10 years, not from a timing standpoint, but from a long-term perspective. It's a more challenging time today than it was 3 years ago. And so the opportunities you have with rates and fixed income have made a difference. And that makes a difference for your 10-year forecast looking forward.
And David, it's not just over the next 10 years. We are at a historic low of an equity risk premium. We have never seen the equity risk premium as compact as it is today.
Yes, we just disagree.
A couple of points I want to try to make, because there's two. Well, first off, I kind of look at the current situation in some of the bond market, particularly the specialty credit and senior loan arena, as a fat pitch. I don't think any of us would have been crying that we might have lost out on the equity market if we bought a 30-year treasury in 1980 paying 11.43%. Number one. Number two, and I don't know whether you've got that slide available. I know it was in in one of the committee meetings. We're not far from these assets. We keep thinking about these assets as they're going to continue to sit there and grow. We're getting ready to start having to take money out of these assets in order to pay benefits. And when we do that, that opens us up to sequence of return risk. And I don't want to go through a big long spiel on sequence of return risk, but you can have an exact same portfolio that does the exact same return over a 10-year period of time. But if your sequence of returns are reversed, you could run out of money in 3 years before the end of the 10-year period, or you could turn around and have twice as much money. And I tell my clients all the time, I don't get paid to pick stocks. I don't get paid to pick bonds. I don't get paid to do any of that. I get paid to manage risk. And that's, if we can lower risk and get the same amount of return, man, I'm all in.
I think that's a great point. There's some path dependency here. To your point, you can pick two very different portfolios that may ultimately end up in the same spot, but there's some real path dependency, especially with the need for funding.
Mr. Cheatham, I think the tables that you're referencing assume that we will not use any of the dividends and interest that are thrown off by the portfolio to pay benefits. If you go back to the cash flow schedules that Mike Lamb gave us today, we have a positive cash flow with interest and dividends. We have a negative cash flow without that amount.
And that means we're taking money to pay benefits.
Yes, but we're not selling assets to do it.
No, they're kicking them out. But if you don't have a dividend paying investment, you're going to have to liquidate them. And that's the problem with sequencer return. You find yourself having to liquidate assets in order to meet cash flow, and you may be liquidating at a good time, or you may be liquidating at a bad time.
Eroding your base is never good in that case, yeah.
Slide 237 is the slide that I think Mr. Cheatham was referring to.
Oh.
That shows the increase of the benefits.
Yeah. Right today, I think we're utilizing some of our investment income to meet benefits, right? If I recall, I think we're bringing in about 100 million.
It'd be negative cash flow otherwise, yes.
Right. I think we're putting probably about 50 million into benefits out of 100 billion investment return. Or Bill, do you know the numbers on that?
I'm sorry.
That
No,
was on the cash flow slide. I'll go find it and send Sherry the.
If I recall, it's roughly in those numbers. So
that's right there on that slide. That's what those
Yeah.
red bars.
Yeah, this is embedded into our work. This is a slide that we build that comes from your actuarial report. We understand you have these cash flows. This is taken into account in all of this asset liability work. That's the difference actually. That's one of the big differences between an asset liability model and just an asset allocation. So this is why we show this. You have to produce, to Mr. Cheatham's point, you have to produce benefit payments from this portfolio. And that sequence of returns matters because in years like 2008, for example, when the markets are down significantly and your portfolio is down, you still have to withdraw cash from it. And what you withdraw doesn't come back, doesn't get the chance to earn back.
Unless your cash withdrawal is from fixed income.
Well, sure. If you pull it all from fixed income, then parts of your portfolio are left alone. Equity markets, for example.
Exactly. So you're not going to have that risk.
So if we keep all of the investment returns in the investment portfolio, does that mean that we have to shift employer contributions to the point that they equal the benefit payments and administrative expenses? And what do we do with the investment portfolio 20 years from now, if we're not allowed to use this net investment income?
Well, I think you're allowed to use the net investment income. What the point of the risk reduction is that you decrease the volatility of the potential drawdowns. To Lyle's point, what you don't want is you don't want to be hitting assets in a period of a very down market because you erode your base and your ability to re-earn that back. So using it's fine. That's part of what this process is. But what we want to do is we want to minimize the magnitude of potential drawdowns and reduce the overall risk of the portfolio.
So, for example, in 2008 and 2009, you had to sell off your equity assets in order to pay benefit payments. You would not have been able to participate in the market recovery at the same level.
And you don't have to go back that far to look. You can go back to 2022 and look at returns. They were negative in both the bond market as well as the equity market. Now, were they kicking off at that point enough interest income in order to provide enough net revenue? Looks like it. But at an ever increasing amount that's going to have to come out at some point in time, that's not going to be the case. assets were put back there to pay benefits at a future date, they're certainly going to get liquidated to do that.
Well, and even if we look at the characteristics of the lower risk A, we are actually increasing the yield of the portfolio. So we're giving you a larger chance to be able to pay those.
That's the point.
Maybe we can go back to page, I think it's 253.
254.
Thanks.
And if you look at that cash yield, we're actually increasing the cash yield by a factor of 33%.
Well, I think all of our discussion basically indicates this is an important decision. And that's why I think we're all engaged in our conversation. And the additional information we received today is very valuable. And I think it's something we can use to deliberate whether or not it's not, we don't need to change our allocation, even if we decide to change our allocation. Timing is not an issue here, I don't think, in the short term. We've been going for 3 hours. I'm not sure how long.
Would you like to put this topic back on the April agenda to discuss further?
I don't know. How long can people sustain more conversation?
So Dr. Hackford, do you think we could put this on the April discussion, give the board members a little time to digest what we've covered today and come back in April for a vote?
I really like our conversation today. I think it's been very enlightening and very helpful. So everyone's contributed. I appreciate that from the investment committee.
From a portfolio management standpoint, you know, the timing, you're right. These are long-term. The implementation takes time, but I do think if we're going to abstain from taking a vote today, you know, I think staff would prefer to we're out of compliance with certain elements of the asset allocation. You know, we've been to some extent using certain assets as proxies for other assets, but for a variety of reasons, there's been limited movement. I think we need direction to either begin to rebalance to what the targets are, or a waiver with regard to existing current allocations that they're under consideration. It's not a compliance violation to continue to maintain. And we would also like a waiver to be able to change the sub-allocation within the existing allocation. And what I mean by that is we are a little bit handcuffed right now in specialty credit. I feel, given my interpretation of the IPS language, we can't make any shifts in the allocations within that portfolio, because any required shift we would have to be reducing the allocation because we're outside of the target range. So assuming that you want to move to vote to delay the vote until the next meeting, I would ask for a waiver on all of that.
Well, I need to ask a question in order to answer your question.
Sure.
One of the questions I had was, what would be your tactical move if we adopted risk A? Would you be selling off equity and putting it into real return?
Well, real return, remember, we're going to have to source some additional investment opportunities. SABA was one of our recommendations, so we need some additional recommendations. I don't think we're doing it right now for K. We're shifting the allocation. They've approved and ratified their new asset allocation. We wouldn't be doing it in, you know, a single move. We're being opportunistic and reducing to targets. We're moving that portfolio towards targets. That's what I would expect, is that if we adopted a new asset allocation over time, and it could be a period of, you know, it's market condition dependent, but we will be looking to move the portfolios towards those targets. Acknowledging that anything that impacts private assets, alternative assets, has a longer runway, both from a deployment of capital as well as a reduction standpoint.
So again, I'll ask you a tactical question. So do you wait to sell the equities until you have a real return investment, or do you turn it to cash and let it sit in cash while you look for the real return investment?
I'd hate to give you an absolute answer to that. I think one of the benefits right now is that our cash portfolio is yielding above near 5.5% is where we've been yielding. So the opportunity cost to sitting in cash is not exceptionally high from a historical standpoint, but it's not something we'd want to do is just generate a lot of cash, have it sit in cash until it's deployed. Our approach has been to use some type of proxy asset over time that has a similar risk return profile. So I would hate to say we're not going to reduce public equities down to the target on day one. We might do that over time. We'll be opportunistic in what the market, what we see as far as what the market opportunity set is. But our goal would be to move towards those targets as quickly, efficiently, and prudently as possible. I'm not sure that was a great answer for you, Bill, but
I think that was a good political answer.
And just looking at the numbers, if he had to liquidate anything, would be coming from the specialty credit portfolio, since it's so far out of kilter. The lower risk A is within a few percentage points on about every asset class we already own, the way we're currently allocated.
Except equity and real return. That's where your movement's going to be.
Yeah, but we're at 4% on earn. We're supposed to be at 13. We're reducing it down to 7. So we would have less work to do to get to the real return allocation. On public equity, we're at 51%. Is that right? Yeah, 51%. So we're 6 percentage points away.
I think we're just 1%. Our goal is our current policy is 50% for public equity, right?
Yes, and we're at 51. So
right.
we're
basically there. We're in the range. Yeah.
We're within 5 percentage points, which is, any of these asset classes, you're going to have a range. It's not going to ever be. It would take less work to make us compliant with, lower risk A than to fix what we currently have.
Correct. And I guess the real question is, these are goals. I mean, so if we're out of compliance, we can do it over time. We can adjust over time. I think that's the strategy that's been employed, I assume, historically.
Well, and ranges are flexibility. We view the outside of the ranges as something we need to address, right? And that's how we viewed it,
right?
And that's what the work is.
Yeah, that's a separate question, Steve. And I think you've been suggesting we need to broaden the range, and I don't disagree with that, because when the market changes, we may be getting out of the range for just because of the market, right?
Yeah, there's some passive element to that. That's what we saw with
beyond your control. It just happens, right?
I would suggest that if we defer a vote until April, we are 4 weeks away from giving you a definitive answer on the asset allocation. Given that the current target has been in place for almost 2 years, I'm not sure you would be making any dramatic shifts in the next 4 weeks, either in terms of needing a waiver for the compliance issue or not. So unless I have a motion to approve a target asset allocation, I think I sense that the board would rather wait until our meeting in April.
I'll make a motion that that staff not make any tactical movements to move to the current target until after the April meeting. Is that what you're asking for, Steve?
Yeah, I think that's fine.
I'll second that.
And to give him the 2 waivers that he requested. I think
I was trying to do that in what I mumbled.
I think that could be inferred from Bill's motion.
Yeah, I think it'd probably be better to actually have the waiver language in the motion. That way, when he does the compliance, it's obvious what was intended.
We've been out of compliance for a while, so I'm not sure that time period changes in a month. Whether or not we need a waiver now, we haven't had it for the last several months, and where we have been out of alignment. I think Bill's motion should be satisfactory.
Any questions about Bill's motion?
Well, I don't think it has a second.
Dr. Hackford seconded.
Oh, I'm sorry. Okay.
Absent any questions, all those in favor of deferring the vote until our April meeting and asking the staff to not make any tactical changes until we give them a new asset allocation, please say aye.
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 Any opposed?
Yes.
Okay, thank you. I think that motion carries. The next few items on our agenda, I am moving to April. We had some bylaws changes that were ready for first reading. We'll move that off to April. The board election policy, there was a public comment today that had raised some questions that I'd like to research a little further before we discuss that one. So that's being moved to April. I checked with staff about moving the administrative regulation and the metro government request to April, and that appears to work fine for their timeline.